Happy evening to all of you. Welcome to today's CPE meeting on Ind AS 32 financial instruments. To handle today's topic, we have with us Samudra Rajan sir. We welcome you sir on behalf of Office of SIRC and all the members of the sir. We will start today's proceedings with the introduction of ICAI officer. Let us all raise to ICAI officer as a part of respect over another institution.
यैषस्सुप्तेषु जागृति यैषस्सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रः ब्रह्मा अस्मिन् लोकः अस्मिन् लोकः सर्वे तदुनात्यधिकश्चन एतद्वैत 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 एतद्वैत
Let me introduce Samudra Rajan SP. He is a chartered accountant with experience in audit and assurance function, including statutory audits, Indian income tax audits and consultancy services. He has been proficiently handling audit engagement for entities in manufacturing, IT sector, financial services, apparel manufacturing company, real estate leasing company, service institute, industries, etc. He is involved in public company accounting oversight board inspection team for inspection of a NASDAQ listed company. His core competencies are accounting standards, financial statement reporting, auditing standards, prudential norms issued by RBI, statutory audit, limited reviews and tax audit, Securities and Exchange Board of India, internal control and SOX reporting. He has handled complex transactions like audit of merger and demerger, along with its accounting compliances requirement of an automotive component supplier and information technology company, audit of transformation from one ERP to another ERP, upgraded version under manufacturing setup and information technology company respectively, SOX compliance audit and reporting to primary team as required by under SOX, business team changes between manufacturing and trading entity along with its regulatory compliances, audit of merger and consolidation along with the accounting as per court order for a service entity, conversion of financial statements from Indian GAAP to Ind AS for phase 2 company. With regard to his industry exposure, he has hands-on experience in statutory, income tax and group audits. He has undergone IFRS training, internal control over financial reporting and risk analysis, income tax audit, Indian Wages Code 2019, fraud risk assessment conducted by Institute of Internal Auditors. He has got many awards and accolades. Some of them are Accelerator Award received during December 2013 for excellence in audit of engagements. Kudos received during December 2014 for excellence in an audit engagement. He was the chairperson of a technical development subcommittee of ASA during 2017. With this brief, I present before you CA Samudra Rajan to handle today's session on Ind AS. May I now request CA Hari Babu sir to come forward and present a short and memento to today's speaker as a token of our love and affection. Over to Samudra Rajan.
So we'll start with the session in other ways. But just one thing right now, I'm with industry and not practice. It's one thing which I don't update with CV. So that's brief and thanks for that introduction to the things. So we'll get into this session today. We'll talk about Ind AS 32 on the financial instruments presentation. But per se, this one single standard alone will not suffice the understanding requirement, because financial instrument per se is a ocean by itself, which has three standards of 109, 107, and 32, which we need to understand together for us to understand it better. But those three standards together, I think we cannot cover it within the given time span to be able to do so. This one standard, how I've structured is I'll take you through some of the important definitions and understanding what is there. And each of the ambits we'll understand with examples, practical challenges, whatever I have faced till now while dealing with this standard. And we'll try to conclude and sum up as to what is our understanding on a basis for this particular agenda. And in my view, this particular standard becomes a base standard for us to proceed further on the financial instruments. Because this is one standard which defines what is financial instrument is all about, what is the sub-element of financial instruments is all about, and gives us a lot of definition along with the disclosure requirement. So agenda, we will cover about definitions. We will understand what is financial assets, what is financial liability, what is equity is all about. And we will also understand about compound financial instruments, classification, and we will end with offsetting, how we will do an offsetting between financial assets and liabilities. That's the sum up which we will do. But whether 2.5 hours will be sufficient is something which I'm not so clear, but we'll try to sum up. Okay. So as I said, we'll have three standards of 109, 32 and 107. 109 actually deals with the recognition, derecognition of financial instruments, classification. It also deals with impairment of the financial instruments, derivatives and hedge accounting, because that one standard is a vast standard which takes care of the recognition measurement principle, and 32 deals with the presentation and 107 deals with the disclosure. This entire three standards makes the annual report or the financial statements together when we talk about financial instrument on a holistic basis. And these three standards are subject to a lot of amendments, a lot of discussion which is going on either at IASB level or at IFRS committee level, considering the practical issues what everybody are facing in this standard. Even if we look at it, there was some recent open comments which is pending with the IFRS on certain transactions. I'll also tell what it is and other things. Day in, day out, there are some amendments which is coming up, some interpretation which is coming up, some practical challenges which are there in the standard. So that's the thing. So to start with, we'll understand what is financial instrument is all about. Financial instrument is pretty simple. It is made up of three components of financial asset, financial liability, and equity instrument. So we'll have to dissect and understand what exactly the three components is all about. With that, we'll be able to understand it better. So to start with, what are financial instruments per se? The standard has said the financial instrument is something where you need to have a contract. Like how we deal in Ind AS 115, where we need to have a contract. Even this standard starts with the terminology called as we need to have a contract, which creates financial asset for one party and financial asset liability for the other party. So the start point for this standard or this entire subject altogether is contract. So now what is contract is all about? Again, we'll go back and refer to 115 or the standard itself, where it says it can be a written document, it can be oral document, or it can be through a mail. So far it's legally enforceable and acceptable documentation. We will consider that as a contract to start with, whether it gives rise to an analysis of financial asset in one organization, financial liability in another organization, and how it works out will be the starting point for the standard altogether. And what all contracts which might be available could be some of the examples like your sale order might become a contract, or your written agreement might become a contract, or a derivative arrangement with a banker might become a contract, or a loan agreement might become a contract. So there are a lot of things which we do practically to say what is covered under contract. Everything is considered even for the standard like how we do for 115. So there is no bigger differences. And the important point is that some of the transactions are not getting covered under the standard. That we will deal it. I'll tell you why it is not getting covered under the standard and why we say those are not contractual or those are not getting covered. So immediately just to call up an example where there are transactions which is not contractual is your payment of statutory dues. The payment of statutory dues you pay on a monthly basis, but there is no contract between the company and the government. So that is not covered under the standard. The next one is typically your constructive obligation, where we have an obligation basis the past trend what we have set in the organization or what we have set as an impression in the market. So those constructive obligations, there is no contract. Technically, for example, if we have created a constructive obligation to say, I pay gratuity once in 2 years, if an employee leaves the organization within 2 years, then that becomes technically a policy which you have been following. You will not have So you will not have any agreement per se, or you have accepted some of the claims from the customers, but you don't have an agreement to it. That becomes a practically followed practices that doesn't get covered under the standard because you don't have a contract per se. That's a practice which you have set, and that gets covered under the respective standards either under Ind AS 12 or Ind AS 57, which takes care of that particular governance and recognition principle, which is not covered here. And some of the contingent liabilities, contingent asset, even though that arises out of Ind AS 37, that also not gets covered here because typically those will not have contracts. So primarily what gets covered under financial instruments, some of the primary instruments, some of the derivative instruments. So primary instruments would be some of the components in the balance sheet and some of the subset what they are giving in the notes to the financial statement might become a derivative information. So we will understand component by component in the balance sheet where we can have financial instrument implications, and we will dwell upon each component as to what implication could be there practically, and then try to understand the standard. So if we start with a particular financial statement, we start with something called as a plant, property, equipment as a first disclosure. So whether PPE is a financial instrument, the answer is no, because technically those are non-current asset where you don't have a contractual right or a contractual so before that I will also explain the definitions of it becomes easy for all of us. So we will first understand what is financial asset is all about, because understanding the asset side is a little easier than understanding the liability side, because liability side has little complexity attached to it as per the standard to identify whether it's an equity or a liability. How do we disclose what takes color of equity, what takes a color of liability, what is compound financial instruments, all those complexity comes under liability and not under the asset. And some of the practical mistakes which people are doing is they try to apply a compound financial instruments even to the asset side. That is technically not required, because analysis of equity and liability is only from an issuer perspective, not from a holder perspective. That's the important understanding which we require. I'll also tell at appropriate point of time what practically people have done as a mistake and why that should not be repeated for analysis and disclosure purpose. So we'll start with what is financial asset is all about. Simplest of an example is cash and bank balance becomes your financial asset. Next one is an equity instrument in the other entity, like investment in the share capital of the other organization, or investment in the debenture of the other organizations, or investment in the preference share capital of the other organization becomes a financial asset. So those two is one limb. The next limb is where you have a contractual right to receive cash or any other financial asset from other entities. So we'll understand this in detail. You have a contractual right to receive cash. So what could be an example for this is trade receivable, which is you have a contract with the customer, you sell, you pass an accounting entry called as account receivable to sale. So that account receivable gives you a contractual right to collect the money in cash. So you have a contractual right, which is your present right today to collect the cash. So there is a present right, there is a past event, and there is a reasonable certainty of future economic inflow coming to the organization. So these three are the basic parameters which we need to see. You should have a present right, there should be a past event, there should be reasonable certainty that the economic inflow will come to the organization. So that becomes your financial asset where you have a contractual right to receive cash. And some of the arrangements could be you have a contractual right to receive some other financial assets. What could be that is you have sold a particular product, you have a right to receive shares of some other organization. So that is again a contractual right where you get shares of the other organization. Again, that's an equity instrument of the other organization which you are going to get. So that's again a financial asset by itself. So again, we will dwell this into little detail. So for example, let's take 2 or 3 examples which will fit, which will not fit. So let's take an example of security deposit, what I have given for a rental arrangement. Security deposit is something which is refundable after a particular period of time. There you again have a contractual right to get the money back. So that becomes a financial asset. For example, there is a prepaid expenses. Prepaid expenses is something which I have paid for a benefit which I am going to get. Whether the benefit was what I am going to get is in the form of cash, the answer is no. The benefit what you are going to get is in the form of services or goods. So that is technically not a financial asset. So what is the underlying is that you should have a present right, there should be past event, there should be a certainty that the economic inflow will come to the organization in the form of cash or other equity instruments, not in the form of goods or services. If it is coming in the form of goods or services, then that's technically not a financial asset per se. So prepaid expenses will not fit with it. Let's take another example of GST receivable. GST receivable is again a balance sheet asset, but you don't have a contract with the government. There is no contract. So you start with a concept of contract, then you go and see whether it falls under cash or equity instrument or a contractual right what you have. You don't have a contractual right there. So that is technically not a financial asset. The next point what they have covered is contractual right to exchange financial asset or financial liability with other entity that are potentially favorable to the entity. So let's understand it better. So we dealt this. So you have accounts receivable, you are exchanging it for shares with the other organization. So far it's potentially favorable to you, it becomes a financial asset. Or why they are covering financial liability here to exchange an asset? The example could be that you have entered into a transaction with your shareholder. You have entered into a transaction with your shareholder, assuming you have sold the goods. You have accounted as accounts receivable to say, he has also invested in your organization, which is nothing but your bank to equity share capital. Or he has given you a loan, assuming bank to loan. Today you are agreeing to net off these two, saying that I will not settle you loan, you need not pay me this money. So that technically becomes your having the right to exchange one financial asset with another financial liability or financial asset technically. So you exchange accounts receivable with shares, that becomes an exchange of financial asset. The exchange of financial asset with one of the financial liability in your balance sheet, then that becomes an exchange. So that is getting covered as part of the financial asset definition. The third line what they are covering is you have a contract that will or may be settled in entity's own equity instrument. Either that is not derivative or derivative. So they started using this wording of derivative, non-derivative, but it's not so complex. So technically we will see what we need to do here and how we will understand derivative, non-derivative, all of that. So let's stick on to the example of trade receivable, what you are going to swap with shares. So there are multiple scenarios which can come up. You might say, I have sold the goods for 100 rupees. You will agree with him, he will pay you 100 rupees in the form of shares. But whether the number of shares is fixed or variable is important. Amount is fixed or variable becomes important. In our given example of trade receivable, this 100 is a fixed number. I have to get 100 rupees from him. How many number of shares I am going to get from him? Whether that is fixed or variable. Assuming his face value is 10 rupees, you get 10 shares. So what happens? You are exchanging a fixed contract with him, fixed amount with him, fixed number of shares with him. There could be other scenario where you get 100 rupees of fixed amount, but number of shares will not be fixed. Maybe he will say, I will give you basis the market value on that day. Assuming your credit days falls due on 30th June. 30th June, what is the market price? He will take that, divide that 100 rupees with market price, arrive at number of shares that he will take. So here what happens? Your amount is fixed, number of shares is variable. So now what fixes and what gets fixed under derivative, what falls under non-derivative is pretty simple. If the number is fixed, if the underlying numbers are fixed, it's derivative. If the underlying numbers are variable, it's not derivative. It's as simple as that. You have a contractual right will be settled in entity's own equity instrument, whether that is through a fixed model or a non-fixed model. If it's a fixed model, it's derivative. If it's a non-fixed model, it's not derivative. It's as simple as that. So the overall financial asset gets broken down into these pieces. One is cash or bank balance, what you have in your account, or a mutual fund, what you have in your account, which is the liquid money, what you have. Other one is equity instrument in the other organization. The third one is where you have a contractual right to receive cash or receive equity instrument of the other organization, or you have a contractual right to settle financial asset with another financial asset of the organization or financial asset with your own financial liability within the organization. You have a contract that will be settled through entities' own equity, whether that can be fixed or non-fixed. Fixed is derivative, non-fixed is not derivative. This is your overall definition of financial asset, what the standard is dealing with. So let's take some of the examples and then see what fixes under financial assets or not. These are all something which I have taken from the institute material only. So let's take first example of investments in bonds and debentures. So where it gets fixed, is it cash? The answer is no. Is it an equity instrument of the other organization? The answer is no, because he will show it as debt in his books. Do you have a contractual right to receive cash? The answer is yes, because you have a contractual right to receive cash, so technically this becomes a financial asset. Next one is loans and receivables, which is pretty straightforward. You have a contractual right to receive cash on a particular given date. You are given a loan, you have a right to receive the money on the due date. You have a receivable of security deposit, or you have a trade receivable, or you have any other receivables with the other organization. So that falls on a due date, you get the money. Deposits given, as I said, you get the money back, so that's technically a financial asset. Trade receivable, other receivable, you have options. You get cash or you get equity instruments of the other organization, or you set it up with your financial liability. All the three options are possible. So you get money from the customer, answer is financial instruments. You get shares of that particular organization or debentures of that particular organization or bonds of that particular organization, still a financial asset. Or you set off with a financial liability within your balance sheet, it's still a financial asset. Cash and cash equivalents, pretty straightforward. Bank balance, pretty straightforward. Investments in equity shares, pretty straightforward. Perpetual debt instruments. What happens in perpetual debt instruments? There is a perpetuity which is attached to it for lifetime of the organization, which means principal will not be paid back, only the coupon which will be paid back, which is your interest or dividend which will be paid to the holder of the financial instruments. So you as a holder of financial instruments, you have a right to get the interest or dividend. You technically don't have a visibility when you will get the principal back. So there is an element of compound financial instruments. I'll deal it a little later. It has a component of equity as well as asset, but from a holder perspective, it's still a financial asset. From an issuer perspective, it has both equity and liability. From a holder perspective, it is still holistic financial asset for you, which will be tested for impairment, but you have a right to receive cash for the coupon what you have on the financial statement. So it's again a financial asset for you. So from a holder perspective, there is no issue of bifurcation of equity liability. There is no classification. It's holistic financial asset. From an issuer perspective, we will see how to deal it. So these are all S's. So now on the no side, let's look at inventory, PPE. Inventory and PPE, is it cash? The answer is no. Is it an equity instrument? The answer is no. Do you have a contractual right to receive cash? Is it yes or no? The answer is no, because you don't have a present rate. You have a future benefit or opportunity for you to use that fixed asset to produce, generate cash, or sell the inventory, earn cash. Those are all futuristic, where you don't have a present right to receive cash. As we said, you need to have a contract, you need to have a present right. You don't have a present right, so that's technically not a financial asset. This goes and sits as a non-current asset on the balance sheet of every organization. Right to use asset, which is Ind AS 116, there you don't have a right to receive cash, because you are taking all the rental agreements, arriving at a present value, disclosing it as a right to use through Ind AS 116. That itself by a notional accounting entry which happens. More from a disclosure and presentation perspective, for us to give a better presentation to the reader of financial statements, you don't have a right to receive cash. You have a contract. In this case, in inventory or PPE, you don't have a contract. Here you have a contract, but you don't have a right to receive cash today. So that by itself is not a financial asset. So once you sell this inventory, then it becomes accounts receivable, which becomes financial asset. Assuming a PPE for a seller of PPE, it is inventory. The moment he sells it, it becomes accounts receivable. For him, it might be upon sale, it becomes financial asset. Until sale, it's not financial asset. Intangibles. Intangible again is equivalent to PPE where you don't have the right to receive cash and other things. Prepaid expenses, as I said, you have a right to receive goods or services. You don't have a right to receive goods. You don't have a right to receive cash. So it's not a financial asset. Advances for goods and services. So what happens? You give an advance for capex purchase or you give an advance for material purchase. What you get it back is material or services. You don't get money back. So it's not a financial asset. So to sum up, a financial asset is where you have a right to receive cash, which is present right. Based your past event, there is a certainty that the future inflow will come. So if these three are fulfilling, then you call it as financial asset or you don't call it as a financial asset. Assuming you have an advance with the vendor, you cancel that particular purchase order, then it becomes an amount receivable from that particular person, it takes a color of other financial asset. You get the money back. You don't get the goods back. So until you reach a point where the inflow to the organization is going to be in the form of cash or equity instruments or netting off its financial liability, it's not financial asset. Until such time, it's non-current asset or current asset. Moment it reaches or fulfills the definition of financial asset, it becomes a financial instrument for us to evaluate under the standard. Until such time, it doesn't fall under the standard. You have Ind AS 16, you have 116, you have Ind AS 38, you have a disclosure which we need to do it, you have a disclosure which we need to do it and technically handle all these pictures and test it for impairment wherever it is required to the Ind AS. So that's how it will go through. Even though we have a lot of elements on the balance sheet, I said second, but this is the summary with which we'll play when it comes to financial asset. So, on financial asset, any questions or anything which we need to discuss or something? Or it's good to know.
One aspect with respect to the GST receivables, I thought it as because it comes from our lines comes based on the statute right now.
So you have a statutory right, so you don't have a contractual right.
That is it, you can set the contract.
There is no contract between you and government, so you cannot demand a government to pay you on what date. Government will decide when they have to pay you. So if there is a contract between you and your customer, you have a definitive date beyond which you can make a legal case. You can sue him. In case of government, you technically have a due date to collect the money, but you cannot sue him, you cannot demand him, nothing can be done. You will have to wait for him to give the money. All your GST refunds, all your schemes, budgetary support schemes, GST refund schemes, whatever the nomenclature which we follow, we don't have a contractual right with the government. Same way TDS receivable. TDS receivable also, you will have to wait till the assessment is getting over, you will have to wait till they pay you money. All your advance taxes, it's only other current assets.
But there is a security of future cash flow.
But you don't have a definitive time period. So the point is you need to have a contract. So the starting point is not getting, you don't have a contract.
The contract may not be covered because contract we are saying it not be overall form. It may not be different from covering all aspects, even it is.
Correct, sir. So what happens in a contract, even if it is in oral form or it's in a mail form, you still have a legal right to sue the other party. Here you cannot sue a government.
In case of where we have a refund order, but we haven't received the amount as a interest much.
So if you have a refund order, there are two views to it. Some people are taking call as other current assets, some people are moving it to other financial assets because you have a right to receive. But there again the time period is not definitive. You still have a right to receive the money through a refund order. You can show it as financial asset, but you cannot demand the money on a particular date. So that's how it goes through. So in our organization, even though we have refund order, we are not showing it as other financial assets. Technically, all my government receivables I'm showing as non-current position. I'm not taking even a current position from you. Even though I know certainly I collect the money, but I'm taking a non-current position to it.
But the non-current financial or not?
We take it as non-financial.
Don't have a
your input tax credit as well as output tax liability is not a financial instrument. Because both you don't have a contractual obligation or a contractual right, both are statutory in nature. But it's not a financial liability. Correct, sir, but it's technically not a financial liability. Assuming as of 31st of March, your liability is more than asset. Let's take an example that your output liability is more than asset. So you will show it as other current liability. You will not show it as other financial liabilities. You will still show. So let's take ESAPF. ESAPF, you don't have input credit. Still, it's a statutory liability, other current liabilities, not other financial liabilities. The point of contract is not getting fulfilled in all these cases where you have a relationship with government. Because those are sovereign bodies where you don't have a contractual right. Let's assume you invest in government bonds, it's financial asset. Because you have a government contract through a bond. So it becomes a financial asset for you. But in case of all these refunds, statutory dues, you don't have a contract with the government.
If it is money outflow,
Money outflow on happening of April 7th. So let's take Ind AS. Until 7th or by 31st of March, you still have a liability to pay the outflow. But that by itself will not create a financial liability. Let's take an example of ESA itself. You have a ESA liability as of 31st of March, you still show it as only liability. You don't debit ESA liability and credit back and show it as BRS item. We never show it as BRS item. So technically that's other current liabilities, not other financial liabilities.
different companies take it, some companies take it as financial liability.
No companies are taking it. Only those refund order has a different position. But some companies are still going and show it as other current asset. But some companies are showing as financial asset because that's up to the auditors and the organization to decide. Otherwise, it's all non-financial instruments. What is the position they are taking? Correct. Correct, sir. But you don't have a contractual right. The point is you need to have a contractual right to demand the government. You cannot demand the government. You cannot make government to pay you unless and until you have an order. If you have an order also, there again there is uncertainty. Whether you get the money or not becomes uncertain. You're assuming you have other litigations pending, they normally adjust it and tell you will wait till the entire bucket of assessment is over. Or if you have a search, they will club with the entire search bucket and say we'll wait till the entire block of assessment is getting over. Even though you have refund order, you don't get the money nowadays. You will have to wait for other consequences to get over. Technically, or if you win at assessment level, they go for appeal. You win at ICAI level, they again go for appeal. So technically, these orders, until it reaches a finality stage of you getting the money and seeing a visible credit into your bank statement, it becomes a little difficult. Even there are certain positions. Let's take an example of this budgetary support scheme which is there in Assam. What happens is, sometime during last year, government took a very different position. This scheme was launched in 2017. So what happens if you put a plant there, do a sale from there, you get your output liability as refund from the government. You will have to pay the output liability, collect the money back, which means you cannot adjust with input, you will have to pay and collect the money. So till 2021 they were paying. They took a different stand saying that you are not getting the refund in excess duty regime, we will not pay you in GST regime. Until March 22, March 23, no organization got a refund. And in March 23, we got an order saying that yes, you can go ahead. CBDT or DGFT gave a clarity saying that yes, it can be processed. But still money is not coming. That is one position. Second position is there are some cases for which at certain level you win it, you get the money also. But the department goes on appeal. There again you still have a dicey position whether to create a provision or not. So dealing with government nowadays becomes very difficult till you reach a finality stage to conclude. Black and white, there is no issue which will come up, or there is no conflicting position which government can take. Until such time, it becomes very difficult for us to conflict.
This one more last point, advance related to goods, whether maybe it is goods or capital goods or services. When there is a co-agreement, I say there is a failure in case of supplying goods or services, you want to return it.
Correct. So that's where I said, moment you cancel the agreement, it becomes financial asset. Until such time, it's not financial. Because you will get the goods or services only, you don't get the money back. Like your AMC contracts or any other contracts where you have paid, for capex you would have paid, or for construction of infrastructure you would have paid, you don't get the money back.
I see that when I see the contractual expense, they say that in case of failure, you have to take that.
So until the failure happens, there is no you will not get the cash. Moment the failure happens also, still practically you will go and talk to him, he will come and talk to you. There will be some other informal arrangements and then try to conclude. Moment you reach a point where there is a certainty of you getting the cash or equity instrument, it doesn't take a color of financial risk. Because
today we are seeing certainty of the cash flow doesn't mean before we are drawing it. So if the method finance doesn't
the moment you have certainty, then you can call it as financial risk. You should have a reasonable certainty to provide with evidences attached to it. Some discussions with the vendor, some formal communication from the vendor acknowledging saying that as I pay you cash, then fine. Until such time you cannot show it as financial risk. Now let's move on to financial liability, more or less the mirror image what we will try to do. Cash and equity instrument will not come. There you had a contractual right to receive cash, here you have a contractual obligation to pay cash, or you have a contractual obligation to deliver any other financial asset or equity. So you have an obligation of settling your borrowing through a equity, that's a financial liability. In your borrowing, there is an obligation for you to settle the liability through issuance of equity, or you as an organization have a liability you are going to offset with financial asset, like trade receivables or anything, then again it's a financial liability. Or there is a contractual obligation to exchange financial asset or financial liability with other entity under conditions that are potentially unfavorable to the entity. So in financial asset we saw that is conditions which are potentially favorable to the organization, here will be potentially unfavorable to the organization technically. And same way you have a contract through which you settle equity derivative, non-derivative. So more or less it's a mirror image what we are trying to do between financial asset and financial liabilities, removing the first two limb of cash and equity because equity is settled as debt separately on the liability side. But the moment you get into the liability side, the important crux point under the standard is we need to evaluate from an issuer perspective. And asset side, its holder perspective, it's pretty straightforward. From an issuer perspective, a lot of complexities in analyzing whether it falls under liability, whether it falls under equity, whether there's a compound financial instruments, whether can you set off or not. So those concepts will come into play. We'll see with examples of multiple liabilities how to be dealt with it because liability side is a little complex. Like a preference shares with differential rights, your debentures with differential rights. There are a lot of other complexities today because treasury is one area where we can see multiple types of arrangements with people will take. They will say on achieving of this profit we will pay you so much, or non-achieving after 3 years you will convert into equity. So when you go to borrowing, you will have to be amenable because you want money. They will put a lot of conditions. So financial liability is one area where you have a lot of play around this particular standard because we can see practically 200 different types of wordings what every organizations are entering into. So that's why financial liability takes a little more time for us to deal within the standard unlike the financial risk. So we'll see. So here again I have taken some of the examples. Loans payable to bank. Yes, you have a contractual obligation to pay cash. It's a financial liability. Trade payable, bills payable. All you have a contractual obligation to pay in cash. Deposit receipt again on a maturity date you will have to pay in cash. Mandatorily redeemable preference shares. So you will have to redeem it on a particular day, pay cash. So it becomes an obligation for you to pay cash. It's a financial liability. Financial guarantee given, there is a contractual obligation on occurrence of certain events. So guarantee technically straight away not a financial liability on occurrence of an event. Moment a guarantee is getting invoked, it becomes financial liability. Until such time, it's a disclosure of contingent liability in your notes to financial statements. Moment it is invoked, it takes a color of financial liability. So until such time, we will only disclose to the financial statements. So some of the examples we'll deal and see how to deal it across. So we'll start with certain examples. So there is a A Limited which is issuing preference shares to B Limited. These are redeemable at the end of 10 years from the date of issue, and the entire holder and entitle the holder to cumulative dividend of 15% per annum. The rate is commensurate with this. So let's go step by step. What is happening? There is a redeemable condition. You will have to pay cash. There is a fixed dividend. You will get the dividend. So is there an option for you to avoid the cash outflow? The answer is no. you need to evaluate all this from an issuer perspective. Whether the issuer has an option to avoid redemption, the answer is no. Whether the issuer has an option to avoid dividend payment, the answer is no. Because it is giving an entitlement to the holder for a cumulative preference shares. So technically, from an issuer perspective, there is no right for him to avoid these liabilities. So it becomes a financial liability. Conditions are met, then it's a financial liability. Let's take next example. A Limited issues debentures to B Limited. Earlier we dealt with preference shares, now we'll go to debentures. These are redeemable at the end of 10 years from the date of issue. Interest is 15% at the discretion of the issuer. Now we have tweaked little bit saying that earlier there was no discretion for the issuer. Now you have discretion for the issuer. Let's evaluate. Principal, do I have a right to avoid? The answer is no. In case of debentures, at the end of 10th year, you will have to pay. So which means for principal, you don't have a discretionary power to avoid the cash outflow. So principal becomes your financial liability. But interest, the issuer has a discretionary right to avoid the payment. So when you have this discretionary right to avoid the payment, it is not a financial liability, it's a component of your equity. It's a component of your equity, which is your compound financial instruments. How to disclose, where to disclose, I'll tell you, because it depends on with whom you have this arrangement. If you have this arrangement with your shareholders, it gets parked called under your SOSI, not under share capital. Under your SOSI, it gets parked in a column called additional paid in equity. It's like additional equity what is given it to you. If it is with a third party, on day one when you are evaluating, it goes to P&L. It goes to retained earnings. So we'll have to see with whom you have this contracts, with whom you have this arrangement, and then decide appropriately where you will have to give an effect to compound financial instruments. I'll deal it in detail with certain examples when we deal with compound financial instruments. So here the conclusion is, loan you don't have an option, it's a financial liability. Interest you have an option, it's equity. The next one is, let's take next example. A takes a loan from C Limited, loan is perpetual. That entitles holder to a fixed rate of interest. Now what happens is, you have principal, you have interest. Interest, the holder is entitled to get the interest, which means I don't have a right to defer the interest. Principal, do I have a right to defer? The answer is not clear, because the loan is perpetual. It will continue till the organization continues, like a residual interest of equity share capital. When I invest in an equity share capital, it's perpetual. Till the organization is there, it will continue. I don't get the money back. So what happens here is, principal takes a color of equity, interest takes a color of liability. So that's where the difference between the earlier element and this example and earlier example. Earlier example, principal is financial liability, interest is equity. Here, interest is financial liability, principal is equity. So you will have to evaluate basis the contract terms and conditions, what is there in the contract, and also take into consideration how the terms and conditions will behave in the future. If you have a futuristic terms and conditions in the contract, that also I'll deal it with examples. You will have some conversion ratios, you will have some ratios and other things. The last example is, does the lack of access to foreign currency or need to obtain approval from a regulatory authority will lead to a contractual obligation? See, it doesn't negate. If you don't have a foreign currency, or if there is a procedure for you to get a RBI approval, or if there is a procedure for you to get customs approval or FEMA approval, that doesn't change the color of financial instruments. Those are all procedural. So those procedure doesn't override our classification. It will still be a financial liability or equity. It doesn't change, because your classification is determined based on the conditions what is there in the standard. You need to have a contractual obligation to pay cash or settle it through your equity, or a contractual obligation to exchange financial assets or financial liability, or a contractual obligation to settle it through equity, fixed or variable, derivative, non-derivative. That takes the importance for you to classify, and not what is given here. But if there is a legal prohibition, we will see how to pay it. Because normally it's a given rule saying that if the law overrides accounting standard, law will prevail. That's the position which we normally take. Say for example, this standard deals with a concept called treasury shares. In India, treasury shares is prohibited. But we have given it here from a consolidation perspective, if we have a subsidiary outside India. Same way, irredeemable preference shares. In India, irredeemable preference shares is prohibited. But standard gives you, but I cannot apply it. But I can apply it during consolidation when I have a foreign subsidiary or a foreign group company, associate JV who has done that standard. So more from a consolidation perspective that has been included in the standard. But from a standalone financial perspective, the law overrides the accounting standard. That's how we will have it.
Sir, one question. What about borrowings which have a lower rate of interest?
I will deal it. That's a compound financial instrument. What happens is there again, what happens just because you have asked, I will tell you. So assuming you have a borrowing of 10 lakhs. Today's market rate comes to 9%. You have borrowed at 3%. What the standard says is, you just impute, you convert this loan with an AER of 9%. This is your equivalent interest rate of 9%. Present value over the tenor. So assuming if your maturity period is 5 years. Assuming 10 lakh I have got, my maturity period is 5 years, my interest rate is 3%. I will put my cash flow. My day 0 cash flow will be nothing. My day first year I will pay 10 lakh into 3%, second year I will pay 10 lakh into 3% likewise. In the fifth year I will pay 10 lakh into 3% plus 10 lakh. I will present value this number, arrive at what is my present value. So this present value will be done at 9%. 9% will be that will be the discount rate. So technically that's your internal rate of return or IPR, which will take your incremental borrowing rate, which you will take to arrive at a discounted present value, show that as your borrowing. Difference, we will have to park it somewhere in the balance sheet because you've got 10 lakh, your present value assuming comes to 8 lakh. Now what happens, your accounting entry is loan debit 10 lakh, credit loan 8 lakh. You need to park this 2 lakh somewhere. That alone I will tell you when we reach compound financial instruments. And this 8 lakh will be imputed with interest of 9% to reach 10 lakh on the maturity rate. That's how it will work. Anyways, I have some examples, I will deal that. That will vary basis from whom you got this borrowing. The next example is delimited issues preference shares to delimited. The holder has an option to convert preference shares to equity at any time up to a period of 10 years. So here what happens, you are given a preference share. The holder has an option to convert it into equity. If it is not exercised, you will have to redeem it at the end of the 10th year. Now what are all the rights which the holder is having is converting this option is with the holder. Contractual obligation is conditional upon holder exercising its rights. But there is always an obligation for you to repay. Within this 10 year, whether the holder will exercise its rights or not is something which you don't know, because that is not within your control. Assuming at the end of the 10th year, if he is not exercising, then you will have to pay cash. So today, my point is I have a contract, I have an obligation to repay at the end of the 10th year on happening or non-happening of events which is not within my control. So there is always an element of repayment which will fall due, it's financial liability. So if you have to classify it as equity, you need to have a threadbare analysis to prove it, saying that you will never pay cash during the tenure, you will pay only like your equity shareholders. At the time of liquidation, where you will have only a residual interest. You need to threadbare and prove saying that the right he gets to collect the money is only on liquidation. That is from a residual value. That is from the net asset of the organization, whatever is left out. Until such time, it is financial liability only. Even if you have 1% chance of you happen to make the payment, if there is still 1% for you, which the event will arise for you to make the payment, it's financial liability.
So it doesn't matter whether the holder is issuer or
The right to convert if it is with issuer. No, that's fair. So we will see. There is a right to convert with the issuer. What happens is there is two things. If I have a right to convert with the issuer, normally I will take an option to convert it into shares. I will not have an interest to repay the money. So there it will become equity. If the right is with the issuer, I will always pay. But that is later. So what happens, normally the intention of the organization will not be to pay the cash. So that's where the intention and with what we are going to play around will be. That's where I said we will touch upon the terms and conditions. I'll take that example. I have that example. So let's take another example. Company issues preference shares redeemable at the end of 5 years from the date of issue. There is settlement alternative to the issue where it can transfer transfer a particular commercial building to the holder whose value is estimated to be significantly higher than the cash value. So what happens is you have a preference share, it is redeemable, but you are not going to pay through cash. You are going to settle it through a commercial building which is not a financial asset. It is not a financial asset. But still this is a financial liability because there is an equivalent of cash outflow which is going to happen to you. Even though the outflow is not in the form of financial asset, it's non-financial asset, still this liability will become a financial liability. Clear? We will see. There is a perpetual instrument with a coupon step up as well as dividend pusher. So we'll see this and then take a call how to disclose it. So you have got 100 million from a particular party, either as preference share or whatever it is, with annual 8% interest payments for 8 years. So there is an element of liability, there is an element of coupon which you will have to pay. Issuer A has a call option embedded in the instrument that allows the instrument to be repurchased at the end of 8th year and every year after you reaching this 100 million. So assuming you reach a turnover of 100 million, you still have an option to purchase back this liability from the holder of the financial instruments. That is one condition. Now the next set of information what we have is that the instrument is not called by the issuer at the end of the 8th year. The interest on the instrument increases to 14% per annum. This is the step-up feature. So what happens till 8th year, as an issuer, I have a right to collect it back and give money. If I am not doing it till the end of 8th year, what happens? The interest rate goes up to 14%. This is the step-up feature what is available in that contract. Issuer A has consistently chosen to pay dividend on its ordinary shares. Issuer A's cost of borrowing for a similar debt when the perpetual instrument is issued is approximately 8%. This is the information what is available. Issuer A does not have indirect or direct obligation to pay cash or another financial asset in respect of perpetual instrument. So now what happens? Let's take element by element. The instrument is perpetual. What I have issued as an instrument to get the money is perpetual, which means what till the lifetime I am not going to pay the money. That's the intention with which I have issued this instrument. So the principal always will become equity because I will never have an intention to repay because I have issued it for perpetuity. The perpetuity right is for paying the dividend. So the principal becomes equity, the interest becomes liability. That is the first point. Now let's look at the next one. Now what happens is issuer A, today is there an obligation for you to pay 8% of interest? That's the next question. The answer what is given there is you have an obligation today but you can still avoid it by moving to a step-up feature. Until 8th year, if I am not paying interest, if I am not paying principal, there is always a step-up feature for the 8% going up to 14%. Whether I still have an obligation to pay that 14%, the answer is no. So I don't have an obligation to pay that 14%. Assuming a scenario where I don't have an obligation to pay even the 8% or 14%, even those takes a color of equity, not a liability. Which means if I am an issuer, I have a right to avoid the payment of cash. Then it takes a color of equity, not a color of liability. This is what on the financial liability is all about. So, any questions on financial liability? I'll just come back to your question also because I've dealt it in compound financial and other things. Any other thing we will have to discuss on financial liability. Then we will understand equity. Then we will understand some more concepts. So let's take the next one as of equity instrument. In case of equity instrument, it's very clear, it's a residual interest. Always equity is a residual interest. Because whatever is left over at the time of liquidation, after paying every party, what is left over comes to the equity shareholder. There is no contractual obligation, there is no contract here. In case of equity shares, there is no contract, there is no contractual obligation, nothing is there. So technically, in case of equity instrument, there is no contractual obligations. You need not pay cash. You don't have an obligation to pay cash. As an equity shareholder, I don't expect the organization to pay me cash until it goes on liquidation. Whether the issuer has an obligation to pay cash, the answer is no. Whether the issuer is having an obligation to pay dividend every year, the answer is no. It's all discretion. It's all the discretion what the issuer is having. That's why it's called as equity, because it's pure residual interest. What is left out in the organization, there is no demand, there is no right from a holder perspective. It takes a color of equity. It takes a color of equity. So, and furthermore is that this can be settled through a issue of another equity instrument. Assuming I have one type of equity instrument today, I want to swap it with another type of equity instrument tomorrow. Still, it's only a swapping between equity instruments. It's technically not a financial liability. Assuming I have different class of shares, class A, class B, class C. I move from class A to class B or class B to class A. That's technically still an equity instrument, not a financial liability. So the underlying substance is that there is no contractual obligation when it comes to equity instrument. I don't pay cash until the company goes on liquidation, and I don't have an obligation to pay dividend also, because purely it's the discretion of the issuer. If these three colors are there, then it takes a color of equity instrument. So let's look at some more little bit complicated ones on puttable instruments. So normally what happens in a puttable instrument is the holder has a right to put it, and then the issuer is obligated to pay the cash. So in case of puttable instrument, let's look at it when it will become equity, when it will become liability in case of a puttable instrument. So assuming if there is no contractual obligation, is there a contractual obligation is the first question. Always contractual, let's deal it first. Is there a contractual obligation? If the answer is no, then it is not getting covered under the standard at all. There is a puttable instrument, but it is not governed through a contract, it goes out of this particular standard. If the answer is yes, is there an obligation to deliver cash or another financial asset? If the answer is yes, it takes a color of financial liability. If this is no, is there an obligation to exchange financial asset or liability under potentially unfavorable condition? If the answer is yes, it's financial liability. If the answer is no, we go and evaluate, is there an obligation to issue own equity instruments, and either of the consideration received or receivable are variable number of equity instruments. Do I have a condition to issue my own equity instruments? So we saw there is an option under your financial liability definition. You have a contractual obligation to pay cash or settle it through your equity instruments. If you have an obligation to settle it through your equity instrument, then it becomes a financial liability. If this is also no, then the obligation to issue own equity instruments and both consideration received are fixed numbers. So technically what happens is I go and take a call saying that what I am going to do with this puttable instruments. I don't have an obligation to pay cash, I don't have an obligation to exchange financial asset, I don't have an obligation to issue any variable number of shares. Everything is clear. The amount is clear, the number of shares are clear, it's fixed to fixed. Then it takes a color of equity, where I know when the holder puts the instrument, I will have to give him these many number of equity shares for this amount. If both are fixed, then it takes a color of equity. If any one element is variable, it takes a color of liability. So, slide will explain that. So let's look at the settlement through own equity. There are two components whenever you settle it through equity. One is the amount, one is the number of shares. So let's take scenarios. Amount is fixed, number of shares is fixed, then it's equity. If any one of the element is variable, then it's liability. So that's where it takes a color. If the amount is fixed, the number of equity is variable, it's a financial liability. If the amount is fixed, equity is fixed, then it's equity. If the amount is variable, number of equity is fixed, then it's financial liability. If the amount is variable and number of equity is also variable, then it's a financial liability. So there should be always a fixed to fixed swap. If there is a fixed to fixed swap, it's equity. So this fixed to fixed swap, why they have called it as equity, why all others they call it as liability, there is a logic to it. So normally when I issue a share, it's always a fixed to fixed swap, what I do with the shareholder. I tell him saying that, boss, you give me this much of money, I'll give you these many number of shares, either at face value or at premium. This is the decision what I have, and both of us are clear what I am going to get, what I am going to give him. So both of us are very clear on what is going to happen. Unlike there is a variable element. If there is any variable element which is involved, then it is not a equity. In case of equity, it's always fixed to fix. There is no variability which is attached to it. So that's where if there is a swap for a fixed to fixed element, it's always equity. Anything which is variable, we'll call it as financial liability.
I have a doubt here actually. We had a similar case where the call option can be exercised only after say 5 years. So at the time of issue, it was not one of the element was variable. That is, the amount is fixed, but the number of shares was variable. So actually initially we had it was treated as compound financial instrument and equity. Then the expert opinion was sought for, and then because the one element is variable, the expert opinion was given that it is only a financial liability. But I don't understand the logic behind it, because at the time of issue, only after 4 years the conversion option is there. How can you fix the number 4 years before?
So that's where it's not fixed, that's where it's not equity. So what happens is,
But here, one law policy says, not only the numbers be a base, but it is a percentage.
100% equal.
it's 100% equity, but still your number of shares is, there is no clarity. Why the number of shares plays a role, I'll tell you. Unless and until your number of shares plays a role, you don't arrive at what is your dilution which is going to happen to the existing shareholders. The dilution is not so clear. And what right I'm going to get in this organization through a voting right, or what I'm going to get in this organization is not so clear for me. When I don't have a clarity, there is no equity. So normally when I issue an equity share, or when I go for subscription of an equity share, I know very clearly if I pay this much, I'll get this many number of shares. This is my right in the organization. But for the existing shareholder also, they will know if I close this particular deal, this is the dilution which is going to happen. So both of us are very clear. Existing shareholders are clear, the new shareholder is clear. But in your example, existing shareholders are also not clear, new shareholders are also not clear. On the
Actually, in
dilution.
our case, the other point was that the person is that it's wholly owned subsidiary. So anyway, dilution doesn't matter, but still we are actually subject to the
The
expert.
characteristics of the equity is what
But then that's what is the point. Whether you are a subsidiary, whether you are a holding company, yeah, whatever it is,
How many other
I will have to treat that organization independently. We cannot combine the informations because these are all independent set of financial statements. I evaluate this transaction at a financial statement level. At a financial statement level, when it is my wholly owned subsidiary as a holding company, if I am sitting in their position with the information, I don't know what is the dilution, what is going to happen.
No, it is going to come to the holding company only.
So, but still, you are not clear on the dilution. Right? On day one, do you have a clarity on the dilution and so on?
Actually, there was, but ultimately it was secret
How you will have, because it's happening on the fourth year, right?
The entire shares will go to the holding company only.
Talking about 100% subsidy.
100% subsidy. The entire.
So, but what, so who will get, so you have given this instrument, who is going to get?
Subsidy has issued the compound financial instrument. I mean, it was not Ind AS compound financial instrument finally. It was converted differentials. So ultimately, the shares are going to be given to the parent company. Supposing 100 shares are given or 1,000 shares are given, it doesn't matter, no? Because it's a holding.
But you will convert on happening of certain event, right, which is fourth year. So this is the preference shares. So if your organization turn out to be a negative net worth, what you will do on the fourth year? Will you still go ahead and convert it? The answer is no. As a holder, I will not convert it. As an issuer also, there is no option for me to convert it. There is no positive equity itself for me to convert it. So those variability is not clear today. In case of equity, whether it is loss or profit, it will go on convert. Like a Zomato IPO, which is very clear, 10 years I'm going to make a loss with its equity. Because as a subscriber to IPO, I know I'm going to get this shares. As an issuer of Zomato, he knows this is what is going to be the dilution. In your case, those events are not within our control. There is no controllable event. And there is no clarity which I have today until I reach the fourth year. So that's where it is called as a financial liability, because normally those will have a clarity only later. You have an obligation, the obligation should be disclosed in the financial statements. Whether it's a residual interest or not, the answer is not clear. So that's where that takes a point. Still. Now moving on to preference shares. Preference shares normally in India it's redeemable, it's not irredeemable, but standard deals with irredeemable, so we are also dealing with it. So let's go to redeemable and then see what has to be done. If the redemption is after a particular specific period, assuming the redemption is very clear, it is going to happen, there is no confusion, it is going to happen after 10 years, and there is no right with the issuer to avoid the redemption, when it's very clear it's liability. If it is based on certain options, there is an option of the issuer, there is an option of the holder. What happens technically, we'll have to understand the interest. If I am a holder of the preference shares, I normally want the cash back. And the issuer have to pay it if it exceeds the right, then it's financial liability. If the issuer has an option to redeem it or not, normally the issuer will not redeem it. He will technically convert it into equity because he avoids the preference dividend, he avoids the cash outflow, it's only residual interest, then it takes a color of equity. So that's how it works when it comes to redeemable preference shares. You will have to see how the redemption option works out, whether it is at a particular point in time, who has the right to redeem it. If the right of redemption is with the issuer, then it's equity. If the right of the redemption is with the holder, it's liability. If the right is very clear after a particular point of time where the issuer cannot avoid it, on the first stage itself, it's liability directly. Let's go to irredeemable. Even though in India it is not there, it's legally prohibited, but I'm dealing it because it's there in the standard. Irredeemable, we'll have to analyze basis the way in which dividend rights are available under the preference shares. Let's go and see how the dividend rights are happening. Dividend rights non-cumulative, cumulative. Under non-cumulative, you have fixed dividend, discretionary dividend. Even discretionary dividend today, it's only a concept which is not there in India, but abroad, I don't know which country has this discretionary dividend for preference shares and all, but it's dealt in the standards I'm just dealing with. So let's take an irredeemable preference share with a dividend rate which is fixed dividend. Again, there is a complexity. How do you arrive at a fixed dividend? Is it reflecting a market rate or is it not reflecting a market rate? Let's take both the options. Let's take first to the market rate. Market rate, what happens? The preference share is not going to get redeemed. The principal will become equity always because I'm not going to pay cash. That is pretty much clear. Now the dividend rights is non-cumulative, where the issuer is not going to accumulate the preference dividend if it is going to be loss making. If it is going to be profit making, then I'll have to pay the dividend. Then it's a fixed rate of dividend, which is reflecting the market rate. Technically what happens here, I cannot avoid if I make a profit and I'm very clear what rate of dividend I'm going to pay, then it's a financial liability. Principal I'm not going to repay, interest I'm going to repay or the coupon I'm going to repay, it's a liability. Now let's take again dividend rate, non-cumulative fixed rate of dividend, but not equivalent to the market rate. Now what happens? I have agreed on a preference share which is irredeemable, but a coupon rate is 4%. Assuming today's market rate is 9%. Now what happens is there is a compound financial instrument involved in it. You will have to present value the cash flow, arrive at what is your preference liability, what is your equity, and that equity will sit in the other equity component. Only for this preference shares, preference liability, you will pay the dividend, which is at EAR. As I said on the loan example, like 10 lakh, we present value at 9%. If it is a preference liability, we will convert that as a preference liability, take every year cash outflow, present value it, arrive at the present value. The difference between the issue price versus the present value goes and sits in equity. This present value becomes your preference liability on which you pay 9%. So, if this is irredeemable, if the dividend is non-cumulative, which is fixed rate of dividend linked to market, its liability. It is fixed rate of dividend not linked to market, then it is having a compound financial instruments. Let's take dividend right as non-cumulative, discretionary, then it's equity, because discretionary is always equity. Discretion of the hands of the issuer is like equity dividend only. There is no compulsion on the issuer to pay you preference dividend. Then it's equity. Let's go and see irredeemable preference shares, dividend right, which is cumulative, which is payable only at the time of liquidation, which means it's again becomes residual interest. Then it's equity, which is payable when profits are available, which is mandatory for you to pay, like a fixed rate of dividend, then it's liability. So preference shares, again straight away it will not be share capital. We will have to see whether it's a liability or whether it's an equity. So redeemable preference shares is always straight away not a liability. You will have to see who has the right to redeem it, at what point of time it is going to redeem, who has the right to avoid the redemption, then classify it as equity or liability. Irredeemable, for your foreign companies, you go and check what is the right which is available. Basis the dividend right, whether it's cumulative, non-cumulative, whether the fixed rate or market linked rate, and in case of non-cumulative, cumulative, whether it is residual or when you pay every year when you make a profit. Basis that, the classification will vary accordingly when it comes to preferences. Let's take some examples and then see. The company issued irredeemable preference shares with a face value of 10 and premium of 90. The share carries a dividend of 8%. However, dividend is paid only when the company declares dividend on equity shares. Now what happens is, your principal is irredeemable. So principal becomes a component of equity. It is not liability. Now you have a dividend of 8%. But this will be paid only when you pay equity dividend. So equity dividend becomes a residual dividend, not a compulsory dividend. It becomes an option. There is always a discretion for the issuer to avoid an equity dividend. If he avoids equity dividend, preference dividend gets awarded. So the entire element becomes equity, not a liability. Your principal is also equity, your dividend is also equity. Let's take another example. Company invests in compulsory convertible preference shares of its subsidiary at 1,000 each, 10 face value, 990 premium. Under the terms of instrument, each CCPS is converted into one equity at the end of 5th year. CCPS carries a dividend and blah blah blah. So what happens? Your conversion ratio is fixed. Your dividend is non-cumulative dividend because you pay only when it's at the discretion of the subsidiary. It's non-cumulative. There is a discretion for the subsidiary to pay dividend or not, and there is no obligation to pay cash. Technically, it's again equity because you are going to convert the principal into equity. You are not going to pay the cash. Dividend is at the discretion, so it becomes residual. So fully again equity. Company borrows 10 lakh, enter into an agreement with the lender for settlement of loan against issue of certain number of equity shares whose value is 3 lakhs. Number of shares is based on fair value of the shares upon settlement. So we discussed saying that if any one of the element is variable, it takes a color of liability. So it becomes liability. So we will just understand what are all the transactions which are outside the scope of financial instruments. Okay. There is interest in subsidiary which is accounted at cost. So technically your interest in subsidiary is falling outside the scope of financial instruments because we don't cover it under 109, we don't cover it under 32, we cover it under Ind AS 27. Why it is getting covered under Ind AS 27? Because you need to understand how the classification works under Ind AS 109. So classification under Ind AS 109 falls under 3 buckets: amortized cost, FETPL, FEOC. That is fair value through P&L, fair value through OC. All your investment in subsidiaries take the color of amortized cost. It is never fair value. Because why it is not fair valued? Because again it's through your SPPA condition, solely for principal and interest. You hold an investment in the equity, you hold it till the maturity. You hold it till the organization survives. You don't have an intention to sell the investment in between. So that's why it takes a color of amortized cost. So technically, let's take an example of investment in an equity of an organization. Okay, I make an investment, let's assume in a startup. What is my intention? My intention is to hold it till the organization survives, or I might have an intention to sell it like mutual funds whenever it's profitable, or I might hold it for a particular period on a particular rate of return then sell it. There are these 3 options which is available. The first option is clear, you want to go along with the company. So it is at amortized cost. There is no change, it is at cost. You need not do fair value because you are not bothered about how the organization is changing. In the second case, you are like mutual fund. You want to make money quickly. So that is through fair value through P&L because you are more bothered about your profit. The third one is you are having an intention to wait for some period of time. Then it can be FEOC or FETPL because Ind AS 28 gives an option only for equity instrument on day 1 to select as equity or your that is FVTPL or FVOCI. So if you are having an intention to run along with the company, it is amortized cost. Immediate profit, then it is FVTPL. Wait for some time on a coupon or on a particular maturity period, then go for it. Then it becomes your FVOCI. So here your intention in subsidiary is always to hold it, go along with the company. So it is not getting covered in 109 or under 38, it goes to Ind AS 27. Interest in associate again same. You will hold it, go along with the associates. Interest in JV, you will go along with them. Rights and obligation under leases is not getting covered under financial instrument. It's covered under 116. Employee rights and obligation is not getting covered under the standard. It's covered under Ind AS 19. Rights and obligation under insurance standard is also not covered here. It is through 104 and now with 117. Forward contract arising in case of business combination is again through 103. Loan commitment other than covered under Ind AS 109 and Ind AS 32 is Ind AS 37. Because you have a commitment, you have an obligation which is covered through Ind AS 37. Share-based payments Ind AS 102. Reimbursement right in respect of provision is again Ind AS 37. Rights and obligation under revenue contract is Ind AS 115. So none of these items are getting covered through these standards, even though you have some liabilities, some assets and everything, but these are all covered through a separate standard. You don't cover it here. So that's why these are outside the scope of 109 and 32. It goes to the respective standards. Now coming back to the same point of puttable instruments. Let's look into it on the puttable instruments. Puttable instrument, the following feature is classified as equity instrument. Rest all goes to the liability. Only when it has these features, the puttable instrument takes a color of equity. Let's look into these 5 elements what the standard deals with. The first one is when it comes to puttable instrument, it gives the holder a right to a pro rata share of entity's net asset in the event of entity's liquidation. So I have a puttable instrument, I'm going to put it across, where I have a residual interest in the organization. If I have a residual interest in the organization, then it is as good as equity. It is not a liability, I am an equity holder. Then there is a puttable instrument. The instrument is in the class of instrument that is subordinate to all other class of instruments. So what happens is, they deal with this concept called a subordinate, which means I don't have a preferential right over any other instruments. I wait like an equity holder. I am a subordinate to everybody else like an equity holder. Then it takes a color of equity. So there is a puttable instrument, but I don't have a preferential right. I have only a subordinate right which goes and sits as called as equity. Then there is a puttable instrument. All financial instruments that is subordinate to all other class of instruments have identical features. Then again, there are group of financial instruments which is subordinate have a typical feature to attach to it, like a subordinate feature, where you are not able to classify which subordinate overtakes whom. Then you treat every subordinate together and call it as equity. Assuming you have class A, class B, class C shares, and everything is subordinate share, but you don't know which subordinate overtakes whom, then everything is equity. The next one is there is a puttable instrument. Total expected cash flow attributable to the instrument over life are based on the profit or loss. So equity is the person who is always dependent on profit or loss. If it's a cumulative preference shares, you go basis what is available irrespective of profit or loss. Non-cumulative, again, you depend based on the profit or loss. So if a person is dependent on profit or loss, then it takes a residuary rate. It's still an equity. So the rest puttable instrument does not include any other contractual obligation to settle or exchange through a financial asset under potentially unfavorable condition. So you don't settle it through any other financial asset or financial liability in an unfavorable point, then it's an equity. You settle it only at a favorable point, then it's an equity. So technically only when it fits under these 5 criteria, the puttable instrument becomes equity. Otherwise it's always a liability. So the standard gives a clear 5 buckets to say when a puttable instrument will become equity. Outside all this 5, it becomes liability. It's as simple. You would test these 5s. If it falls under residuary interest, if it falls under subordinate, or if it depends on P&L, or if you are not going to settle on an unfavorable position, then it is equity. Rest all you go and take it as financial liability. So let's see some of the examples. Let's take ABC Limited as 2 class of shares, Class A and Class B. On liquidation, Class B shares are entitled to a pro rata share of entity's residual interest. There is no limit which is set for Class A shares in the residual assets on the liquidity. Now what happens? Class B shares have a cap limit on the residuary interest. So normally what happens to equity shareholder? There is no cap limit on the residuary interest. Upon liquidation, whatever is the left out amount will be shared equally among the equity shareholder. There is no cap limit. Here there is a cap limit which is set for Class B. So then that is not an equity. Class A, there is no limit to rights of Class A shareholders and there is no cap limit at all. They are treated like equity shareholders. So Class A becomes equity, Class B doesn't become an equity. Let's take next example. T Limited has issued a puttable ordinary shares and puttable A ordinary shares, two different type of ordinary shares, puttable instrument, which are entitled to one vote per share, whereas holders of A ordinary shares are not entitled to any voting rights. So one type of puttable share has a voting right, one type of puttable share doesn't have a voting right. The holders of both the classes will receive equal share when it is on liquidation. So what happens? Neither of the classes are equity. What happens here is both the classes don't have an appropriate feature of voting rights, and identifying which subordinate overtakes whom becomes the most difficult challenge. Because there is one person having a voting right, one person doesn't have a voting right, it's more to do with the voting position. But which subordinate overtakes whom is not so clear here. So technically I cannot say a class that is normal ordinary shares, puttable of ordinary shares is equity, puttable of A ordinary shares is non-equity and not able to class. So in this scenario what we will do is we will call both as non-equity because you are not able to identify which one is equity. So technically you take a conservative position and call both of them as non-equity. So whenever there is a dicey position, you take a call on a conservative basis to call it as non-equity. So next one is on the reclassification from equity to liability or liability to equity. How will you do it? So let's think of a point where we have a financial liability. Upon the preference shares is getting converted, it becomes an equity. Now how do I value my equity is the question. What the standard says is whatever is the value of financial liability on the date of conversion becomes the value of equity. It's pretty straightforward. Whatever is the value on the date of conversion of the financial liability to equity becomes your equity value. Nothing to be done. You have preference shares in the books, you have cumulative dividend in the books, both put together becomes the value of equity. Now you are moving from equity to financial liability. What the standard says is you need to fair value, arrive at what will be the financial liability and then show that as financial liability. Remaining you will have to see where to keep it, either in equity or in equity. So when there is a reclassification, what happens is you will have to arrive at whether it is equity to financial liability or financial liability to equity. Financial liability to equity, pretty simple. Just pass in accounting entry, close it. Debit here, credit there, close it. Debit of financial liability, credit of equity. When you are moving from equity to financial liability, you will have to do a fair value, arrive at what is the difference in the fair value, park it in your equity. But this reclassification happens when the conditions are fulfilled. So what happens is you need to be very clear. The reclassification can be done only when the instrument fulfills the condition of definition of financial liability or definition of equity, which we saw there is a contractual obligation, there is no contractual obligation. When those conditions are fulfilled, you go and test and convert this into another set of equity or go and convert this into financial liability. That's how you will test it. So now let's go and look at the next option. There is something called as a contingent settlement, which means settlement happens which is depending on a contingency. Let's look at example, then go to the flow chart. Assuming there is a entity A issues preference shares paying 5% non-cumulative dividend that are at the discretion of the issuer. Shares will be redeemed if the applicable taxation or accounting requirements were to change. Now what they are telling is, I issue a preference shares which is having a 5% non-cumulative dividend and there is a discretion to the issuer. I will redeem it only on happening of tax law changes or accounting changes. The contingent event here is changes in taxation or accounting requirement. The requirement for redemption on change of taxation or accounting requirements represents a contingent settlement because it is contingent on something happening which is not within your control. But contingency is very genuine. It can result in delivery of cash or other financial asset or liability. So when it is beyond your control, but you are certain saying that if it happens, you will have to pay cash, then it's financial liability. Which means on happening of this event, like our example of 10 years, within 10 years, if the person is not coming and converting it to you, you still have a obligation to pay cash. Likewise, if the tax law changes or the accounting requirement changes, assuming in the next 3 years it changes, you will have to pay. If the changes happens, you don't have a right to avoid the liability or avoid the cash outflow. When you don't have a right to avoid the cash outflow, then it's technically a financial liability, not an equity. Now let's look at the next component which is available within this particular example is there is a 5% dividend which is at the discretion of entity A. So that is a equity, which means I have a right to avoid paying dividend on the preference shares as an issuer. As an issuer, I can avoid paying dividend, which means it's a component of equity, not a liability. I don't have an obligation to pay cash. But what happens is there is a catch here. Your dividend is only 5%, not equivalent to the market rate. So the dividend component alone becomes a compound financial instruments. The principal becomes a full financial instruments. So just to summarize, you have a principal element which is repayable on the change which is going to happen, which is not within your control. It's a financial liability. Once the change happens, you don't have a right to avoid it. Dividend is something which you can avoid it as per example. The moment you avoid it, it's equity. But it's at 5%, not at market rate. The moment it is below the market rate, it's compound financial instruments. How to deal compound financial instruments? I have some examples which we will take it.
How will we treat that as an equity? Because it's non-cumulative.
So that's where I said, what happens is this non-cumulative dividend, it's at the discretion. So it's non-cumulative, it's discretion. But you will have to check when you will have to pay. So you will go back and check those non-cumulative conditions. On non-cumulative basis, if the profit comes out, when I will pay. When there is loss, I don't pay. In case of non-cumulative, the cumulative, non-cumulative, the only difference is if there is a loss, in case of cumulative, you will have to still pay. In case of non-cumulative, you need not pay. But if you have a profit, you will have to pay. You cannot avoid it. But only right, what I have is even though I have a profit, I have a right to avoid the dividend. But that is equity. But I still have a cap limit of only 5%, not 9%. So I will have to check if I have an intention to pay. If I pay at 9%, what is the component? The difference between 5% and 9% becomes equity, the balance becomes your liability. So assuming if I have an intention to pay, if I take a call to pay, that is not at market rate. So assuming you are holding a preference shares with me, I have earned a profit, I have made up my mind to pay you dividend. I will pay you 5%, but that's technically not at market rate. The difference between 5% and 9% becomes an equity. That's the only thing. But in case of non-cumulative, it's straight away not avoidable. In our example, it is avoidable, but generally it is not avoidable. Non-cumulative is always when there is a profit, you will have to pay. If it's a loss, you need not cumulate it. In case of cumulative dividend, irrespective of profit or loss, you will have to pay. That's the subtle difference between these two. But here, if I make up a decision to pay you, it is below market rate where I will go and test that element of compound financial instruments. Let's take next example of contingent settlement. There is entity B issues shares, dividend are discretionary, entity B must redeem the shares for par in the event of flotation or IPO. Entity B cannot guarantee a successful IPO, but it does have a discretion as to whether or not to instigate the proceeding to float to seek an IPO. Given that there is, so what happens here is you have an option as an issuer to go ahead and then do IPO and then succeed that IPO. What happens if I have an issue, if I am an issuer, I am confident saying that I am going to float for an IPO, I am going to succeed it, then what happens is I am going to avoid the redemption. The right is with me to avoid the redemption. The moment I succeed the IPO, then it takes a color of equity. But if I am not going to succeed, then it takes a color of liability. But today I am confident saying that I am succeeding, and I am also clear saying that I am not going to remove from floating of IPO. I am very clear on the path of IPO and also confident on the success, then it takes a color of green. So let's take one more example. Entity C issues shares. Entity C must redeem the shares at par, and even the entity C is not able to successfully complete the IPO within 5 years from the date of issue. Entity C cannot guarantee a successful flotation, but it does have discretion as to whether or not to instigate. Which means here it is not clear, and it is also not clear whether to go ahead with the IPO or not. It still is thinking. He is having an option to avoid the IPO. If he is having an option to avoid the IPO, then it takes a color of a liability, which means he has to repay. Then the last one of contingent settlement provision is change of control. So assuming there is a change, so what happens? Entity D issues preference shares. Entity D must redeem the preference shares at par in the event there is a change in the control of entity D. Change in the control is defined in the terms of preference shares as a change in ownership of at least 51% of the ordinary shares. Given that contingent event, the sale of ordinary shares by one set of shareholders is not in the control of entity D, it's a contingent settlement provision. So what happens? I will redeem only when there is a change in the control. But whether the change in the control is in the hands of the issuer, the answer is no, because he cannot control it. Because the entity D cannot avoid redeeming the preference share, it becomes financial liability, which means it's like our earlier example. So what happens when there is a requirement for change in accounting or taxation, which is not within my control. If it happens, I have to pay. Here again, there is only change in the control. If change in control is not within my restricted rights. If there is change in the control which is going to happen, then I have to pay. Then it takes a color of financial liability. There it was accounting or tax requirement. Here it's only a control in the number of shares. The voting right if it changes. But I cannot avoid the changes in the shareholding because it's between the two shareholders. If shareholder A and B wants to change the share and change the control, I cannot avoid it. If that happens, I have to pay. Then it's a financial liability. This we saw. Okay. Let's take some more. So far, any other questions? Clear, not clear?
Sir, basic preference shares complications. Those short financial liability, we can transfer it to equity. What is the consequence of
It becomes if you will have to show it as financial liability, and if you show it as equity, whereas then it's
then the colleagues?
becomes a non-compliance to the account. So technically, when there is a non-compliance, then it becomes a non-compliance to the requirement of the Companies Act, where you will have a modifier. Auditors will not agree to this position. That is where
Even the auditor also will have the same complication.
the management is responsible for adherence to the accounting standards.
Classify which
What happens? You have decided to show it as equity. You have taken a call. This is not in line with the accounting standard. So then, as a management, you will still go ahead and present that way only your financial statements. This is not in line with the accounting standard, or it will go ahead and qualify. But you will have a qualification even in the ICAI. It will be the other internal control over financial.
Okay. Just one note, you said equity instruments at amortized cost and joint venture also based on the case. What about it's not an associate, not a joint venture? Company owns say 10% or 5%.
Of a third party. Of a third party.
But it has no intention to sell it or something. Then
So what happens in that case? Ind AS 28 gives you an option. If it's an equity instrument, if you have invested on an equity instrument, first time you have an option to sell it as FVTPL or FVOCA. First time irrevocable option. You can select either as FVTPL or FVOCA. Moment you select it, all your fair value changes will go on. But it's one time which is available only for equity instruments. If you are investing on debentures, you don't have that right. If you are investing on equity, you can select FVTPL or FVOCA. It's an irrevocable right. So some decisions which we have also taken in a startup investment as FEOC or FETP, depending on the volume, depending on our intention, a lot of things. First time selection we are also doing. Any questions or clear, not clear? It's a little bit confusing.
Yeah,
Little bit. To close it. So let's take some examples to deal with our earlier continuation of this fixed to fixed, fixed to variable and other things. So there is an organization which is issuing convertible debentures for a subscription of 100 crore. The debentures are convertible after 5 years into equity, issuing at a predetermined formula. So now what happens is contracts uses equity as a settlement mode. So what happens here is there is a convertible option, which is the debentures are getting converted into equity after a period of 5 years, but as per the predefined formula. So what happens? Your number of instruments is becoming variable. So technically it becomes a liability. It's not fixed to fixed. So this fixed to fixed criteria plays a huge role and it creates a lot of confusion. Even sometimes I wonder why this fixed to fixed is also playing a role, but still that's how the standard is working and some intention, some logic is there attached to it on the dilution and other things. So we go with fixed to fixed. There is an organization which is issuing convertible debentures for subscription of 100 crore. Those debentures are convertible after 5 years into 15 crore equity shares of 10 each. Here it's fixed to fixed. So it's pretty clear, so it's equity. So there is an organization which purchased an option from another organization entitling to subscribe a fixed number of equity share at a fixed price at any time after a period of 3 months. Holder pays an initial premium of 2 rupees. So what happens here? It's again fixed to fixed. But it is equity. Assuming if the excise option is benchmarked to an index, then it becomes a liability. The last one is there is an organization which writes an option wherein the holder can purchase equity shares at a price that fluctuates in response to the share price of the issuer. As per the term, if the share price is less than 50, option can be exchanged at 40. If share price is equal to or more than 50, option can be exchanged at 60. So the amount is variable, number of equity is fixed, so it becomes liability. So if any one becomes variable, it takes a color of liability. But these are all some of the rarest transactions. Many companies are not getting into it, but the standard deals with it. So another example is A Limited enters into an arrangement with shareholders of T Limited, wherein A Limited will purchase shares of T Limited in share swap agreement against a variable amount of cash, that is market value. The swap ratio is agreed. Here what happens is your settlement is variable amount, but the settlement is for fixed number of instruments. It is having an option of a derivative liability. It is derivative liability or asset for both the parties and not equity. It is technically not an equity. What happens is the underlying derives a value from the market. So the swap ratio is fixed. There is 1:5 or the 1:5. Your number of shares swap ratio is fixed. But your amount is not fixed. But your amount arrival also is not fixed. It is not within your control, it is within the control of market. So technically that becomes a derivative where you do a mark to market analysis and then do that. Let's take another example. On Jan 1st, an organization subscribes to convertible financial instruments of another organization. The conversion ratio, if it is converted up to March 31st to 1:1, converted up to June 31st is 1:1.3, converted up to December 31st is 1:2, which means at different point of time the conversion ratio is varying. But that doesn't change the underlying amount or the underlying number of equity. The underlying number of equity is fixed at a particular point of time. If I excise by March 31st, the amount is fixed, share is fixed. If I excise by June 30th, amount is fixed, share is fixed. If I excise by December 31st, amount is fixed, share is fixed. It's equity. There is no variability which is involved here.
But as a March 31st, how do you know which ratio to use?
No, that's why he will excise it. So the holder will excise it. Holder, when he excises, it's fixed. It is not the issuer who is excising it. The subscriber is going to excise the conversion.
But for the issuer, for doing the balance sheet and treating it as equity, what is the amount that is to be considered?
Amount is same. So here what happens is your amount of conversion is same. So assuming I have issued a preference shares of 1 crore rupees. You are coming to me and asking me for a conversion of 1:1. Entry is preference share debit, equity share capital credit of 1 crore. You are coming on June 30th. Again, it is 1 crore only. Value is 1 crore. Your number of shares is only going to reduce.
I have one. As of the first one, like I doesn't come out and say the date of conversion. First March he has not given his answer. But it could be 30th June or 31st. He is still by
The timing is only no, sir. The timing is only going to change. But your number when he is exercising on every date is fixed.
As of 31st March, I don't know whether it will be June 30 or June 30.
So
Then
tell
the
us
equity number is different. In future, it may choose 30.
If number changes, amount also will change. No?
amount is fixed.
But this is variable.
Your 1 crore is always fixed. Your number is basis what conversion he is going to do. But it is with him as a right. So technically on that day the amount is fixed. What happens is if on that day the number is going to be variable only, it takes a couple of time. So what happens on the rate of conversion, it should become variable number. On the rate of conversion, I know this is what I am going to convert. So at the time of issuance, if he is going to come on March 31st, I am clear, assuming I have issued 1 lakh preference shares for 1 crore rupee. 1:1 on March 31st, it's 1 lakh equity share, 1 crore rupee. If it is on June 31st, it is 75,000 equity share, 1 crore rupee. If it is on December 31st, it's 50,000 equity share, 1 crore rupee. Fixed to fix. There is no variability. No, the dilution is very clear here. Your dilution is clear here. The number is not varying. The number is clear on every given day. Correct, sir, but your dilution is very clear. That's what I'm telling you. The dilution is not variable. If it happens on March 31st, this is the dilution. Dilution is the number of shares only here. It's not an amount because your amount is fixed. So assuming you do a diluted EPS, on March 31st you go and do a diluted EPS. What happens on March 31st? You will presume whether it is June 31st or December 30th, depending on what is going to happen. But outer limit is December 30th. So you will go and see what is your number of shares which is going to increase, basis which your diluted EPS is going to change.
So what do you mean to say? Suppose as on December 31st, my conversion is going to be based on the date, then it becomes a correct.
Because your number is varying.
One part is fixed.
Correct. But here both are fixed. Convinced, not convinced. So what I'm saying to you is on the date of issuance, the existing shareholder, new shareholder, both are very clear what is going to happen. On 3 different dates. Only the date is different, but your component is fixed. So when this is fixed in both the places, it is
Suppose they are converting existing option the ratio will be fixed.
correct.
So now the existing shareholders will be 1,000 but different shareholders will be 1.5 then 1,500 shares.
Oh, correct.
Right. So the 1,500 shares what are they? For that 1,000 existing shareholders is happening.
So, but your dilution is very clear on the time of issue itself. So, on the time of issue, you as an existing shareholder know if the party is going to exercise on December 31st, your dilution is going to be 50%. If he is going to exercise on, if he is going to exercise on March 31st, it's going to be 50%. If it's going to be on June 30th, it's going to be 75%. Here it is going to be the other way around.
You mean that at time of issue it is fixed.
Correct.
That's why
Correct. On any given day it is fixed. So, assuming if this is not 1:1, so assuming this 1:1, I am arriving based on a market rate. Market rate, the number of shares varies. Or I arrive based on your profitability index, assuming EPS on March 31st, EPS on June 30th, it will be. Assuming I do it on some other ratio, assuming your current ratio or your other ratios, which is not within my control. Here everything is within my control. If he exceeds on this date, I know this is the number. On this date, this is the number. On this date, this is the number. So the control of fixed to fixed is available on day one. No, sir, what I am telling you is, in her given example, what happens is, the conversion happens on 4th year, but your conversion ratio was not clear. Okay? So you don't have clarity on the conversion ratio. So you don't know what is the dilution which is going to happen. Here you are clear, if it happens on June 30th, this is my dilution. If it happens on June 30th, this is my dilution. If it happens on December 31st, this is my dilution. I'm very clear. Then it's equity. If I'm clear, this is what is going to happen, then it's equity. The next one is on Jan 1st. There is an organization which is subscribing to a convertible preference shares. The conversion ratio is 1:1. The terms of the instrument entitled to proportionately more equity share in the case of share split or bonus issue. What happens is, convertible preference shares can be classified as equity in the books of the issuer. The variability is only with respect to protection of the holder. The conversion is always expected to be in fixed ratio, hence it is an equity value. The variability is only with respect to protection rates. What happens here is, you have a conversion ratio which is fixed, you have an amount which is fixed, but the number of equity share might vary if there is a share split or bonus split. What happens if there is a share split or bonus split, even to the existing shareholder is going to happen. So it is always at fixed to fixed. I cannot have a share split of 1:1, he cannot have 2:1. I cannot have a bonus share of 1:1, he cannot have 2:1. It's always common. So then, to that extent, it is fixed to fixed, so it is equity. So let's take another example. On Jan 1st, there is an organization which is subscribing to convertible preference shares of another organization at 100 per share. The conversion is 10:1. On a fully diluted basis, the organization is entitled to 30% stake in the other organization. If subsequent to issue, if the issuing organization, that is, the condition here is, if subsequent to issue, if the issuer is going to issue any other equity instrument at a price lower than 10% of share conversion ratio, will be changed to compensate the other organization for dilution in its stake. What happens here is, your conversion ratio, which is fixed here of 10:1, is becoming variable if the issuer is going to subsequently issue the shares. If the issuer is subsequently going to issue the share, assuming on today the number of shareholders are 1000. If I do 10:1, what will happen is, for every 10 preference shares what I am holding, I get 1 share. So assuming I hold 100 preference shares. Today what happens, 100 divided by 10, I get 10 preference shares. So what is the ratio? 1000 equity shareholders, 10 preference shareholders. 10 equity shares will get added. Assuming tomorrow if they are going to issue further shares, before this conversion, assuming they are going to issue 1100 shares. Now what happens, it's 1100:10. The ratio is getting diluted, it's not 10:1. So then to that extent you will have to increase the number of shares for him to reach the same 10:1, which means it will become 1100:11. Your ratio is fixed but number of equity shares vary. On Jan 1st, NG Limited subscriber to convertible preference shares of 100 on a fully diluted basis, he gets 30% stake. The preference shares are convertible at fair value. So here again the value is getting changed, so the preference shares is not residual value, it's a financial liability. There is an option which is available which takes a color of equity, that's all. So it takes a color of financial liability. Okay. So another example is, there is an organization which subscribes to preference shares of another organization. The conversion ratio is like this. 1:1 if the enterprise value is $100 million. 1:5 if the enterprise value is $150 million. 2:1 if the enterprise value changes. 3:1 if none of the things are happening. But individual events, they are all individual events. But what happens is, the number of shares are getting changed based on the value of the enterprise. So to that extent it becomes a fixed and a variable element. So then to that extent, on day one I don't have a clarity whether it will be a fixed equity number, because this enterprise value achieving is not within my control. Enterprise value achieving is dependent on future events, so it's clarity. Let's assume there is an organization, again your 1:1 is basis another investor investing within 1 year, another investor investing within 2 years, another investor. So here again, these are all discrete events. But what happens is, the number of arrangements can be considered as economically equivalent to 4 separate contracts. Price per share and amount per share is fixed in all 4 scenarios. What happens here is 1:1 if the strategic investor invests in the issuer within 1 year, 1:1 if prospectus filing is successful, 2:1 if filing sale agreement is successful, 3:1. So what happens is, if these things are clear on day 1, then it's equity. If the clarity is not there on day 1, then it goes to life. So you need to have very clear clarity on day 1 as to what is the fixed to fixed which is going to happen. So contingent settlement position is okay. Now coming on to compound financial instruments. Any questions? Now let's take a concept of compound financial instruments. What happens is, in this case, there is 2 compound which will be involved. One is an obligation to settle cash, one is an obligation to issue equity instruments. So those 2 will be there. If those 2 are embedded into a particular contract, then it becomes a compound financial instruments. It has both the color. It has a color of one portion as a financial liability, one portion as a equity. We'll see certain examples and then understand how it will work. Okay. Let's assume there is a redeemable preference shares with discretionary dividend. X Limited issues to Y Limited. These are redeemable at the end of 10 years. Interest of 15% at the discretion of the issuer. The rate is commensurate with the creditors. What happens is, mandatory redemption for a fixed date, fixed amount. Interest is of discretion. So what happens? Your principal is fixed. Amount is fixed, date is fixed, you cannot avoid the liability, it is liability. But your dividend is at the discretion, it is equity. So it is a compound financial instrument. One is liability, one is equity. Let's take next one. There is a loan. The loan is perpetual at a fixed rate of interest. Here again, interest is fixed, but your principal is not fixed. So interest takes a color of liability, principal takes a color of equity. So it's again a compound financial instrument.
So, but we just have a question. In the Companies Act, is it possible to make perpetual loans or intercorporate loans and other not specified?
It should have. So that's what I said. In Companies Act, this is not possible. In our Companies Act, this is technically not possible. But under the standard, under global scenario, it is still possible. But here we cannot do it. Here we need to have a maximum tenor along with the interest rate, interest free. I cannot give it, all those things unless and until those conditions. So next one is D Limited issues preference shares to D Limited. The holder has an option to convert these preference shares to equity anytime up to 10 years. If the option is not exceeds, it is redeemed at the end of 10 years. So there is a contractual obligation to pay, then it is a financial liability. But there is a conversion option which is with the holder, then to the extent of conversion option it is equity, whether he exceeds it or not. So now coming on to this borrowing, whatever you asked for. So what happens here is, borrowing practically I've seen 2-3 scenarios. One borrowing from a promoter, one borrowing from a third party. So borrowing from a third party today, what happens under the Companies Act? If that party is going to be a company, it cannot be lower than the market rate. So technically it will lead to the market rate. Assuming if that person is going to be an individual or any other partnership form or something, then it can be a lower rate. So let's take an example where you are getting from a promoter. So you are getting a loan which is repayable after 10 years with a 0% interest rate. What the standard says is, you need to arrive at a present value by imputing interest onto it at a year. Arrive at the present value will become loan, the difference will be called as additional paid in equity. Under your SOSI, you will have to show it as additional paid in equity. This is your permanent equity contribution from the promoter. It is like an equity contribution. He is not charging you interest, he is foregoing the interest. Foregoing the interest is like an equity contribution to the organization that will sit permanently on the liability. That is permanently on the other equity, it will not change. Now let's take another example where you are getting from a third party. Same example, the difference will goes to P&L on day one. Because that's a profit what you are getting on day one. That's the certain difference what you will have to do. Impute interest. So what happens if you do a present value, it comes to 7 crore. On 7 crore you will have to charge a notional interest every year, it will reach 10 crore on the maturity date. So your overall other equity is neutral. You create a credit of 3 crore on day one, you create a debit of 3 crore over a period of time, your other equity is neutral. But where it is neutral is something different. In case of promoter, there is other equity, additional paid in equity, there is a debit in retained earnings. Overall equity becomes zero. In case of third party, on day one you credit the retained earnings, over a period you debit the retained earnings through P&L. Still, retained earnings become zero overall and other equity becomes zero overall. So P&L is always neutral, but on day one you will have to do a present value and account this because you are getting a notional benefit on day one. So that's the substance of this compound financial instruments, where you will have to arrive at what is the compound which you are going to get across.
Is this mandatory because financial liabilities will be paid at amortized cost?
So you cannot have a loan which is below your market rate. If it is below your market rate, you get a notional benefit where you will have to do a compound financial instrument. That is not avoidable. That is clear. You cannot avoid it. You will have to mandatorily do this accounting and then show it across. When you are under Ind AS, it is not possible unless and until you call it as an immaterial effect on the financial statements. You can take a materiality call and then leave it across, but whether it will become material or not, it depends on the interest rate what you are accruing. So assuming you are accruing a 7.5% interest rate, market rate is 7.7%, technically the 0.2% will not matter. Or you do a graded rate. So you do first 5 years 7%, next 5 years 8%, then next 5 years is market rate, first 5 years is it not market rate. Or you do a market linked, which is say assuming it's LIBOR plus percentage or SOFR plus percentage after June 30th, but that is not matching to your local rate, then we will see what is the compound.
Because companies have this permitting interest rate loans from holding company. So
That's where I said if it is from an investor, so if it is from a promoter, which is your holding company, this notional amount will be called as additional paid in equity. You will have to show it as additional paid in equity. But only thing, when you can move this additional paid in equity to retained earnings is a concept by itself. What happens is, there is one technical guide which came on capital reserve transformation to retained earnings recently. What they said is, you can move your capital reserve to retained earnings. If it is created through a law, you cannot transfer it unless a little law allows you to do it. If it is created through an accounting standard, Ind AS, assuming you do a business combination or you do a slump purchase, your consideration is more than the underlying asset. The difference goes and gets debited as your capital reserve. But the guidance says you can move the capital reserve to retained earnings when the underlying is getting settled. So assuming you sell that asset or you remove that division out of your organization, so that gets settled, you move it to retained earnings. Same way in case of other additional paid in equity, moment you settle this loan, you move it to retained earnings. That's how it will be there, it becomes a distributable profit. So technically you have imputed a notional interest on P&L, you move this there, it is available for distribution. But you can do it only when the underlying gets closed. Until such time you cannot do it. But this is the mandatory requirement. So again there is a GST loan which is from government at nil rate. Again you need to do this imputation and other things. But government technically is not your shareholder unless and until it's a PSU or when you have a government holding. If it's a government holding, again it goes to additional paid in equity. If it is non-government, it goes to PSU. Preference shares with dividend rate difference from market rate. Again, instead of loan, you keep it as preference shares, you do a present value. If it is from a promoter or holding company, you show it as additional paid in equity. If it is from a third party, on day one, you take it to P&L. So, assuming other way around, now we have seen a lower rate, assuming it's a higher rate, what you are paying. Then the difference will go and sit as your additional paid in equity debit balance, P&L debit balance on day one if it's from a third party. So what happens is, if you are ending up paying more, notionally you are paying more, which will be debited on day one. It's like your owner's liability. The owner's liability comes to the P&L on day one. The notional gain comes to P&L on day one, and over a period it gets offset. Same way, on day one you book a loss, over a period you offset it.
is there any effect to be given in the books of the company which is giving the loan? This is only in the
So in the books of company which is giving the loan, what happens? In your example, in case of holding company, there you will do a present value. What happens is, whatever loan which you are given will be shown as your financial asset at present value. Difference will be added to the cost of investment. So assuming today you have invested 100% of stake at 1 crore rupee. You are giving me a loan of 10 lakh. The present value comes to 8 lakh. Your cost of investment will become 1 crore 2 lakh. Your loan value will be 8 lakh. There you will add an equivalent mirror image, you will give it there. Here you are adding to equity, there you will add it to your investment, cost of investment.
On a consolidated.
This is something which is again not a normal transaction. But I have not dealt it, this I have dealt it between holding company and subsidiary. This I have dealt it between promoter and the company. I have not dealt it across holding and subsidiary relationship. That's where I put it as promoter, but if it is from a holding company, then that's not. So anything on compound financial instruments? Okay. So this is again nothing but your split accounting where you will decide what is liability. Whatever we have so far discussed as compound financial instruments is again getting splitted and accounted. We will understand with examples how will you split it and account it. Okay. Let's take an example where there is a loan which is taken. The holder for 12 lakh rupees, the loan is perpetual and entitles holder to a fixed rate of interest at 8%. Rate of interest commensurate with credit risk is 12%. What happens here is your principal is perpetual, but your interest is not equal to the market rate. What you will have to do is, you get 8% interest on 12 lakh rupees, which is 96,000. You get 96,000 every year, which should be discounted at 12%. So what happens? This comes to 8 lakh rupees. But what is the amount which you have paid is 12 lakh rupees. The difference between 12 lakh and 8 lakh is 4 lakh becomes your component of equity. So technically what you will have to do is, whatever is your cash flow, you will have to do a present value at EAR. The difference goes to equity. On this 8 lakh, you start accounting 12% interest. It reaches 12 lakh on the maturity. Any question here?
Ind AS is mandatory for the network criteria has come out, but after
No other criteria is come. No other criteria. Correct. The 500 to 50 listed entity mandatory, subsidiary holding associate of the entity was adopted in days after adopted days. That's same. That is not changed. That is not changed. But I see off late a lot of entities are doing voluntary adoption because that helps them to play with the market. Have a comparable financial statements. Otherwise, the financial statement in a lot of places is not becoming comparable. Even now, we have taken a call in our group because our holding company, ultimate holding company, holding and our associate companies are in Ind AS. But we have other group companies which is only a common related party through directors and others, not through a shareholding. We have taken a call, we will do a voluntary adoption in March 2023. Now what happens, the entire group will have Ind AS common accounting policy for ease of business. There is everybody are following a different policy, different method of accounting. Somebody is following it. So that's the call we have taken.
This PNL schedule 3 where exactly is where is it like amortized or?
So this is again the interest. So interest will go as part of your finance cost. Finance cost. Just finance cost. There's no doubt here, is it? Because I made some wording very particularly to create some confusion. So only thing, my point of view is, this question and answer will not tell you. It will not tell you. Just read the question, read the answer, it is not telling you. It's actually not telling you. Some information is missing.
SOT for how many years? Is for perpetual?
That's where it's the problem. So, once it becomes perpetual, you will have to do it for how many years becomes a question. So there what happens is, normally there is no set guidance which is available. The practically followed principle is 99 years. Like your long-term lease which is taken for land. That's where is the only change. Okay. Next one is optionally convertible redeemable preference shares. So what happens is, the organization issues preference shares to another organization for a consideration of 10 lakh. The holder has an option to convert these preference shares to a fixed number of instrument at any time up to a period of 3 years. If the option is not exercised, then they are redeemed at the end of 3 years. The preference shares carries a fixed coupon of 6% payable every year, but market rate is 9%. Now what you do is, for this period of 3 years, you present value this 10 lakh at 9%, arrive at what is the value. Same way, your interest, which is at 6%, you present value at 9%. So both the cash flows, what happens is you pay this 10 lakh at the end of third year, you pay the 60,000 every year. So your cash flows for a period of 3 years, 60,000. 10th year, third year is 10 lakh. So technically first 2 years is 60, third year is 10 lakh 60,000. You will present value at 9%. Total comes to 924. The difference between your 10 lakh less 924 is your equity. So let's take the same example further, iterate as to what are complications which can happen. So you get a cash flow of 10 lakh, you pay 60, 10 lakh 60, you do a present value, effective interest rate, everything 75, all those numbers are right. Now let's change the fact. Assuming D Limited has an early redemption option to pay the instrument at 11 lakh on June 30th, which is here. June 30th, 2023 instead of June 30th, 2024, you have an option to early pay at 11 lakh rupees. At June 30th, the interest rate has been changed. At that time, D Limited could have issued 1 more year maturity non-convertible debenture at 5%. Calculate the value of liability and equity. Now what happens is, an organization has an option to pay 11 lakh on June 30th. But at this rate, the maturity, if I am going to issue 1 more year of investment, that will be at a rate of 5%. Now what happens is, the principal value which is on 30th June for a 1 year time, which is of 10 lakh, which is getting discounted. What happens here is your cash outflow technically should have been only 10 lakh. So that 10 lakh you discount it for 1 year, you get an amount of 9 lakh 52 because your early payment is 1 year. And present value of the interest payable of 60,000 which you are avoiding is 57,000. The total liability, had you paid after waiting 1 year, will be technically 10 lakh 9,000, but you are paying 11 lakhs. So this 90,000 becomes an equity component. The next point what we need to see is, there is a difference between this liability what you are arriving here vis-a-vis the liability which is existing on June 30th. So what happened? Had you continued this model, what would have happened is, your liability on June 30th would have been 9,72,000. Because of you changing a model, what happens is you are early paying the 10 lakh and 60,000. So your liability goes up to 10 lakh 90,000. So this difference of 37,000 goes and hits your P&L. So there is 2 entry here. One, your early paying this number will have a differential liability. Liability versus liability, there is a difference which you go and hit the P&L. Liability versus consideration payment goes and hits your P&L. So that's how it will happen. So if you pass an accounting entry, what you will pass is debit P&L, credit liability for 37,000. You will bring it to 10 lakh 9,000. Then you will pay this and credit the equity. Debit liability for 10 lakh 9,000 and then you will credit the consideration. This will go to equity component 90,000. Getting it? So technically what happens, your outflow at the end of 30th June is 10 lakh. Is the same 10 lakh, is worth 10 lakh today? It's not. Because I am paying 1 year earlier. 1 year earlier value, if I do a future value of 10 lakh to present value of 10 lakh is 9 lakh 50,000. Future value of 60,000 to present value of 60,000 is 57,000. So technically my liability today is only 10 lakh 9,000 if I do those present value 1 year earlier. So my total liability component is 10 lakh 9,000. What I have in the balance sheet is 9 lakh 70,000. The difference is my P&L entry, which is my additional interest which I am ready to bear. And what I am going to pay against 10 lakh 9,000, I am going to pay 11 lakh. So this difference of 90,000 will go and hit the other equity. So technically, what I am driving here is, it will not be only liability versus equity, it can be liability versus liability also. Any questions on the split accounting? So split accounting technically need not go only to equity, it can go to liability. It can go to P&L also. So we'll go to the reclassification. So reclassification, we said it's between liability and equity, we discussed fine. Okay, now coming on to treasury shares. This treasury share as a concept is not there in India. It is prohibited. It's like you buying your own share and keeping it in your balance sheet. But this is still allowed in global practices. So this standard is dealt. So if the entity requires its own equity instrument, those shall be deducted from equity. What happens is you don't recognize the gain or loss in the P&L, but you go and adjust it within the cancellation of equity instruments. So such treasury shares are acquired held by the entity just for consolidation purpose only. So what happens is the difference between your consideration versus your face value, what it sits in the books, that goes and hits your equity only. Technically you go and hit your equity, bring your equity back. From the market. It's not technically a buyback because buyback is allowed. You are repurchasing your own share not through a buyback model, through an open market model. You as an organization buying back your own share through an open market model. That is prohibited in India. If you go through a buyback model under Companies Act, it is still allowed. Because you are using your profits and then you are buying back. Here you are using your cash and buying back in your open source of market, which is not allowed. But globally these are allowed. In India these are not allowed. Next one on the standard is about how do you disclose interest, dividend, loss and gains. So if it is relating to a financial instrument or a financial liability, it shall be accounted in the P&L. If it is relating to equity, it shall be adjusted in equity net of taxes. Why here net of taxes? Why it is not net of taxes? Because P&L automatically takes care from your PBT tax. In equity, once you hit it, it should go to your equity net of tax. So what happens here is, I will give you an example and we will see how to deal it. Okay. So assuming entity A issues a non-cumulative preference share that is mandatorily redeemable for cash, during the lifetime of the instrument, the dividends are payable at discretion of entity A. The non-cumulative preference shares is issued at so and so. The non-cumulative redeemable preference shares are compound instrument. The liability is determined at present value. What happens is, you are having this 10 million of redemption, but the non-cumulative preference shares is issued as 8 million. So what you will do is you will arrive at a liability which is present value and then take this difference to your equity component. And unwinding discount, when you unwind the discount, you go and account it in the P&L because these are all the instruments which is relating to a liability. If it is relating to a liability, you go and take it to P&L, the unwinding component. If it is relating to an equity, the unwinding component goes to equity. So just to give an example, let's take a borrowing. Okay, let's take a borrowing. When you unwind it, the borrowing is a liability. When you unwind it, the interest cost goes to P&L. When you unwind a equity component, assuming you present value and show a particular financial instrument as an equity, the unwinding component again comes to equity directly. Because of the difference in the number of rate and other things. So what happens is you are not issued at a fair price. You are not going to pay a dividend at a fair price. So what happens? Redeemable. The principal portion will be liability. The dividend portion will be equity. There is one more concept of transaction cost. What happens is, under Ind AS, we are allowed to adjust the transaction cost on issue of equity. But that will be adjusted under other equity, not with share capital. Because under Companies Act, you are not allowed to adjust anything with share capital. You can adjust under other equity as part of your retained earnings or other equity debit balance, whatever you want to show, you can show it, not under share capital because that is prohibited. But I see off late, some of the accounts where they have adjusted in share capital itself, that's wrong. And one more error which is being pointed out by FRRB also is that whatever equity and liability which we are seeing now is from the perspective of the issuer. But there are organizations who are older are also doing this accounting, which is not correct. So assuming there is a borrowing which is given, that is correct. But they have invested on preference shares who are not a holding company, but they are doing this accounting. Borrower who are not a holding company are doing this accounting of showing as investment and other things, which is not correct. So we are coming on to the last one, which is on offsetting. So normally offsetting principle is very clear. You can offset a financial asset and financial liability which is presented on the balance sheet if there is a legal enforceable right for you to adjust it. So this is normal. If you have a legal enforceable right, you go and adjust a liability and then asset. Or then you can adjust it if there is no legal enforceable right or intends either to settle on a net basis or realize the asset and settle the liability simultaneously. So So what happens? I have a legal right and go and set it. Or I have an intention to settle net. I have an intention to receive and pay simultaneously, then I can do a net accounting. But there is some more thing. In case of in accounting for a transfer of financial asset that does not qualify for derecognition, the entity shall not offset the financial asset and financial liability. What happens is, in some cases you have financial asset and liability which originates at the same point of time. But when you transfer a financial asset, need not be that you should set off the financial liabilities. So that way you need not do it. So for example, you borrow. There is a cash, there is a borrowing. Cash is also a financial asset, borrowing is a financial liability. But when you transfer the cash, that doesn't mean that you will set off the liability. And offsetting can be inappropriate. There are certain scenarios where offsetting is inappropriate. What happens is there are different financial instruments imitate the feature of a single financial transaction. What happens is you have multiple financial instruments on your balance sheet, but all put together takes a color of a single financial transaction. In that case, you cannot adjust it. What happens? Let's assume you have 2 or 3 borrowings or 2 or 3 preference shares or one asset, one liability, and all those things, which is taking a color of a single financial transaction. Then in that case, you cannot offset it because those are single financial transactions, a standalone financial transactions, not a combined financial transactions. For example, let's take you borrowed an external commercial borrowing in US dollar. You enter into a principal only swap, you enter into an interest swap. Assuming your borrowing is from ICAI, you enter into a principal swap with ICAI, you enter into an interest swap with HDFC. You have MTM gain, you have MTM loss, but you cannot set it off because both are 2 different parties. Both are 2 different transactions, you cannot set it off. So that's what they are saying is financial instruments having same primary risk but involve different counterparties, you cannot do it. So these are not single financial, these are different individual transactions, these are different counterparties, you cannot adjust it. Asset pledged as a collateral for non-financial liabilities. Assuming you have a non-financial liability and you have an asset which is pledged as a collateral for it. So assuming your non-financial liability, let's take an example of your employee gratuity fund or this one, which is your non-financial liability. Assuming you have a non-financial liability in the books. Okay, assuming you have that provision to the extent. Or let's take an example of a warranty provision. Warranty is a non-financial liability because you don't pay cash. You give your product and then settle your warranty. And you have pledged your fixed deposit as a guarantee to your customer. Then you cannot net off your financial asset and liability. Financial asset will not be available for netting off. Financial assets are set aside in trust by a debtor to discharge an obligation, which means you have set aside a particular liability to discharge a different obligation. Then you cannot adjust that financial asset. Last one is obligation to recover loss arising from a third party by virtue of a claim from an insurance contract. What happens is you have a liability and you have a receivable. Receivable is from insurance company, but you have an obligation also. These 2 you cannot net off because those 2 are different counterparties. And the obligation is from a third party, but claim is from an insurance company. So those 2 you cannot net it off. So what we'll do is we'll just summarize. What happens is overall we have discussed about what is your financial instruments, financial asset, financial liability, equity. We've also touched upon what is your financial asset definition, financial liability definition, how equity will work, how your putable instrument will work, how your preference shares will work, and on what are all conditions you will have compound financial instruments, and when you will decide as an equity, when you will decide as a liability. And we have also discussed about your contingent settlement. We discussed about this offsetting, we discussed about how do you account for interest, dividends, gains and losses. Treasury anyways is not there, then reclassification. So, I think it's left this particular slide. So contingent event, is the contingent event is within the control of the issuer? If the answer is yes, it goes to equity. This slide compares financial asset, financial liability and equity. Financial asset is cash and equity. There is a contractual right, there is a contractual obligation, no contractual obligation. I can exchange financial asset with financial liability which is potentially favorable, potentially unfavorable. To exchange financial asset which is potentially unfavorable. A contract that will be settled in equity or own equity instrument. Contract that will be settled in equity or own equity instrument, variable number or fixed number. If it is fixed to fixed, then takes color of if it is variable, takes color of liability.
The aspect of dividend and interest, you said net of tax.
What I said is when you do an unwinding, so if it is on a liability, when you do an unwinding, it goes to P&L. If it is on equity, when you do an unwinding to equity, it should be net of tax. Because your P&L is always before tax. Tax takes care of those adjustments. But if it is directly to equity, you cannot account it. You will have to account it net of tax, which is nothing but a deferred tax adjustment. That's pretty much what I have. And derivative hedge accounting and all those things. This by itself is a separate bucket which we can deal for days together because this is a huge component by itself. And derivatives is separate, hedge accounting is separate. How do you do a hedge documentation? How do you do a hedge effectiveness? How do you do a mark-to-market accounting on taking to P&L, taking to OCI? How do you do a quarterly adjustment when it's listed entity? A lot of things which is complicated. Derivatives again. How do you do a MTM? How do you account the MTM? How do you adjust it? Is itself a different ballgame. Impairment of financial asset is something which by itself is becoming a problem day by day when you invest on other companies. So when you invest on a startup, then the valuation report should be looked into it. The recent financial statement should be looked into it. DCF becomes a problem. Valuation report itself becomes a problem day by day. The valuation report becomes unreliable. They're talking about a loss. Recently, I saw a valuation report. Next 3 years is loss making. My value of investment is 60,000 rupees. Totally, I have invested only 60,000 rupees. He's saying after 5 years, per equity share will cost 60,000 rupees. I know where from because next 3 years is loss making projection. Same way, Zomato is something which is not even I can understand. Paytm, I cannot understand how they get a valuation. Because today valuation becomes a multiplier on top line, multiplier on EBITDA, multiplier on so many other factors. So it becomes not reliable. Very difficult. So that's where it becomes very, very difficult for us to do a fair valuation under the standard. So some of the organizations are taking a call not to rely on their valuation report, take the latest audited financial, look at net worth, arrive at what is my net worth change and then account it. And we have taken a call, if it is gain, we will not account it, if it is a loss, we will account it. Wherever it is through CPE, but it becomes very difficult for us to convince the auditors because they are not agreeing to it, but it becomes an emotional impact on the P&L when we account the gain. And next year showing a loss tampers the entire financial statements. If it is OCA, at least it's okay. If it is P&L, it tampers the entire color to the financial statement. Valuation report is not reliable. So what happens is we saw a particular valuation report in February which showed 582 rupees per share. May showed 620 per share. September showed 18 per share. So that's where, because they are fudging the numbers. Total numbers are fudged, total number of stores are fudged, top line is fudged, everything is fudged, and they are agreeing to it, saying that they have fudged it. Then we have not invested to the next we are predicting, but we saw these different numbers playing the ball game.
But generally, we can rely on the valuation report for 3 years.
Nobody's valuation is changing in the next 3 months. Next 3 months it's changing. Your one round of valuation, your one round of investment valuation is totally different from second round of investment
For the purpose
valuation.
of impairment testing.
That's why I'm telling you that becomes not relevant at all. Totally unrelevant. So we are not able to take any call on startups. Whether to invest or not itself becomes a ball game. But that's a risky game which we'll have to take. Again, to do a fair valuation, arrive at gain or loss, arrive at impairment is all something that's where we took a call saying that we'll go business audited financial statements. But again, here the point is how far audited financial statement is reliable is again something which becomes a question. So as an organization, we have taken a decision after 25 lakhs. Every investment above 25 lakhs, we will do an independent due diligence. That at least will throw some light to it as the call we have taken. With that, we wanted to do this impairment concept. So every year, annual impairment, annual due diligence, we have doing, but that costs a lot for us. But there is no other option which I have. Classification, okay. Derivative only problem is on a forward or a derivative with a banker becomes very clear. But if you do a strategic purchase and protect your rate with your vendor, it is all through a mail documentation where it is not clear. So I go and protect my purchase price with a vendor saying that you supply to me in June, July, August at 90 rupees. I will purchase from you 1 lakh quantity, which is all through mail, but that's still a derivative. It's a commodity derivative where you will have to do a mark to market, but those are not available on paper for us to evaluate it. So there are a lot of things which is not available on transparent basis till now. Those things we will have to work, read and play around. Typical example of disclosures will be very complicated. MSME, there is no available data unless and until vendor tells me. Struck off, it is in PDF, I don't have SIN number in my vendor master. There is no correlating point. EPCG, there is no public record to identify how many license and organizations are in. So a lot of things in accounting versus practical is not considering together. That's a disclosure anyways. Today in the annual report, there are a lot of disclosure requirements right from your credit risk assessment, your currency risk assessment, what is your currency fluctuation, sensitivity analysis, what is your balance sheet classification of financial assets and financial liabilities into 3 buckets, amortized cost, FVTPL, FVOCA, how you have arrived at FVTPL, FVOCA, level 1, level 2, level 3 indicators. A lot of disclosures are there. So those this by itself is again an ocean where we'll have to deal with. This is the bigger ocean where we'll have to deal with. And the recent amendment, what I said is that I saw one recent study which IFRS committee has dealt, but they have not moved it to IFRIC. What they have dealt is, there is a derivative contract between entity A and B. Entity C is giving a guarantee on that derivative. There is a guarantee which is given on the derivative between entity A and B. They are telling if entity B fails, then this guarantee can be invoked subject to the market price available on that day. So how to disclose it was a question, whether it's a guarantee or a derivative. Some people are telling it's guarantee, some people are telling it's derivative. But if you go and read the definition, guarantee deals only with debt instruments. It doesn't deal with a derivative instrument. So IFRIC has not concluded. What IFRIC has said is these are rare transactions and impact might not be material is the call they have taken. But there are these kind of rarest transactions are also coming up. Guarantee on a derivative, which I have not seen at all. So those are cropping up, which makes this particular standard more live. And taxonomy to the standard is also very complicated. How do you do this XPRL mapping, what we call it as taxonomy mapping, is also becoming a challenge because you show this notional in the P&L, tax authorities don't understand this notional. You go and do this adjustment in your computation. He doesn't understand what is this computation is all about. He is taking a call saying that whatever is credit you pay tax, whatever is debit you don't pay tax. So there are a lot of this which is happening because of this one. Not only this standard, even Ind AS 116 becomes a problem. He doesn't understand why the rent is not appearing in the P&L. How to link it, they are not understanding. But that's a complex position which we are going through. Over a period, I think they will get a understanding and then we will have to do it. But there are a lot of wrong accounting, wrong presentation, wrong disclosures which are happening here, like in this standard. More from an accounting policy perspective, also something is going wrong. From a disclosure is also going wrong. So that's pretty much. Any questions we can take?
There's only one question. If you go back to the fundamental subject over form, if you invoke that, then most of the financial assets can be created. The cases which she has said, she has brought it with the reference shares with the
So what happens is IFRS and Ind AS today set on a concept called principle, not on a rule. So principle allows you to do a substance over form. But then what happens is your substance over form should have very clear clarity and threadbare convincing evidence. What happens in our example, the threadbare convincing evidence of how much of dilution will happen, what will happen after 4 years, there is no visibility. If you are able to prove with a reasonable certainty saying that this will be the threadbare position, this will be the convincing evidence, then you can still do a substance over form. Then that itself will become a form. The moment you have this visibility, that might itself will become black and white. Why it's not coming in black and white or why all the treasury documents take a different color is because it's not possible. Somebody will say after 5 years you make so much of profit or else give me. after 5 years if you make so much of profit, convert this into 2x. If your EBITDA is 5x multiplier, give me 3x redemption. All these treasury documents only can create different color to the entire stuff. Because I want money, I'm listening to them.
But this case, 100% subsidy is what I'm saying.
Now it's amalgamated also. Now it is only one term.
So still on that
And
day
then
you
the
don't
thing
have
is
the money.
cancelled. The issue shares are cancelled because of the amalgamation. But still, just because the fixed word was not there, the expert opinion gave a reply saying it's a financial word.
Because of the dilution. So what happens is when you have to arrive at a diluted EPS on day one, you will not be able to arrive at it with clarity. You need to arrive at a diluted EPS, right? You cannot arrive at it with clarity. You will not include this as part of your dilution itself. So assuming in year one, you would not be able to calculate a diluted EPS in that scenario. Because you know this is your numerator adjustment, but your denominator adjustment you will not know. You cannot estimate your denominator adjustment also. So your diluted EPS will have one wording saying that this does not include this adjustment. That's where it becomes a liability. You cannot estimate it. Even though it is within the holding company, you are not able to arrive at a diluted EPS.
Can we have this material for revision purpose?
I can share. You can share it. Across. Maybe you just don't think you just write down your WhatsApp numbers with your name and just send it across. It's okay.
So we could revise it.
I was
Good evening, friends. On behalf of members present here and on behalf of SIRC of ICAI, I thank CS Sundarathan for his excellent and detailed presentation on Ind AS 32 financial instruments.